Recording in progress. The meeting delayed, it started.
Why is the TV? There's an issue with the TV.
Give full screen projector source.
On.
Yeah.
Now, okay.
It's done, right? Open Zoom and keep.
Yes. You side or no? You side. What? Stop it. Yeah. I got it.
Okay, so I have two of you in. Right, so Karushi, I went through your mock exam. You got 40. Okay, so Karushi got 40 and who else sent it to me? Abdul Basit got 45 and Yumna also got 40, right? So today we'll be going through that paper. So first things first, I understand from the papers that some of you have not really, got there yet, 100%. You have not really learned the entire syllabus because there were a lot of blank questions. Okay. So, like some of you, for example, I think one paper, section A and B was really good, but section C, I think there was just one question attempted. Okay. So, if the other question is attempted, definitely you're going to get more than 50, right? Yeah, so yeah, Yumna has just joined. Yumna, I went through your mark, you got 40. Okay. So for the good news is the mock having happened at the beginning of the month, it has given you enough time to, analyze where you stand. Okay, you have enough time now to analyze where you stand and see what you have to do to somehow pass this exam well. Okay, now first things first, I will tell you 40, 45, they're actually good marks. Why? Because that is before you have properly prepared. Okay, so easily you can add another 40 marks if you can give it your 100% this month. Okay, so what I will do now is with regard to the mock, there was something different that happened this particular session, and that is section A and B. You guys have been able to kind of tackle it fine. Okay, most of the time students have a problem with A and B. They find it a little tricky, but with the three papers that I got, I realized that most of you are okay with A and B. It's section C that's the issue, right? So for section C, I'll tell you one of the main reasons why you have found it difficult is because you were scared to attempt. You're scared to attempt the question. Why is that fear there? Because you have not done enough questions in the past. Okay, so for section C, the only way for you to get confidence and actually sit for the paper is to make sure that you have done enough and more questions from that particular area. So for example, investment appraisal, if you have done about 10 section C questions, guys, one of that is only going to come for your exam. So same thing for all the chapters. Cost of capital, if you had done 10 particular questions, one of those are only going to come for your exam. Okay, so it will either be from investment appraisal, cost of capital, business valuation, or working capital management. Risk management, they usually don't test in section C. If at all they do, it will only be a small portion. Okay, so it won't be a big calculation per se. Okay, so the only way you can kind of get the hang of section C, I'm telling you, is to do questions. Even if you study the syllabus, you won't really get that confidence. Only doing the questions will give you that confidence. Okay, right. So let me go ahead and open up that paper. I have to tell you, it was a relatively easy paper. Okay, I don't want to sugarcoat and say, no, it was a hard paper. It was a relatively easy paper. Once we do things like the pre-mock and stuff, and even when you try out section C questions, you will realize that in terms of complexity, they can ask a lot more. Okay, so what I gave you was relatively easy. So let me just put it up. The marking scheme, I will share it with you. I will tell them to upload it onto the LMS as soon as possible. Okay. When somebody asks me for the revision kit, guys, the PDF of the revision kit, contact somebody at PPIM. You can contact the hotline. They will be able to share it with you. I can't share it because I have kind of like a software. So unfortunately, it's not shareable. Okay. Yes. Hello, Dashra. Dashra, you're in PPIM, right? Okay, can you just, I have sent something to the Premier Partners Gmail account, but it's not signed in. Will you be able to sign in on this tab? Yeah. For the guidance. Usually it's signed in, right? Today, for some reason it's signed up. Right.
Oh. So, morning.
Something.
Thank you.
Yeah. Okay. So I'm getting messages asking for marks. So let me see who this is. Inshifa. Inshifa, I don't think I received your paper, Inshifa. I have not received. I've only got Tarushi's, Yumna's, and Abdul Basit. Okay, I asked you to send it to my Gmail. Just check if it has come. If not, doesn't matter because I'll be going through the whole paper today. Okay. Right. So let's go through this paper. Okay. So it says here you get 3 hours and 15 minutes, but in your exam, it's actually 3 hours. Just the 15 minutes is for you to read. Okay. So you won't be able to really go through the paper or anything as such during that time. Okay. So it says here, please note that the real exam is a computer-based exam. Therefore, the questions in this paper version reflect the question formats of a computer-based exam. Okay. And then, yeah, don't open the paper and all that. Fine. Right. So if you look at the first bit, right, the first section A and section B, it's relatively simple. Okay. So let's go through it one by one. While I'm doing the questions, I will kind of explain that area as well. Okay. So it says all 15 questions are compulsory and must be attempted. Each question is worth 2 marks. Okay. So question 1, they're asking the agency problem refers to which one of the following situations. Okay. So this is one of, always in your paper, the first few questions will be a little easy because even the examiner wants you to kind of ease into the paper. Okay. So that's why I always, if somebody comes and asks me what's the order we should do the questions in, my suggestion is to always do it in the order that the examiner has given. Okay, because he has also put it in a way where once you do one theory question, the next one will be a calculation. If it's a long calculation, the next question will be an easy theory question, right? So following the examiner's order itself is a good idea. Okay, unless and until you, unless and of course you kind of, panic in section C and all of that. If you do that, then might as well do that first. But otherwise, doing it in this order is the best approach. Okay. So agency problem, I'm sure you already know this. The owners are different when it comes to a company. Okay, so when it comes to the company, owners are the shareholders. Everybody knows that. Okay, but the people who actually run the company, they are the directors or the managers. Okay, they are the ones who run the company. So the problem is people who run the company only tend to have more control over that particular company because they are the ones who are running. Okay, so what happens is they might take decisions. The managers might take decisions that are going to benefit the managers and not the shareholders, which is not really fair because the owners are the shareholders. So ideally, everybody should work for the shareholders' benefit. But sometimes it can happen the other way around. Okay, so that is only the agency problem. So let's see if we have that answer. It says shareholders acting in their own short-term interest rather than long-term interest of the company. It's not the shareholders acting. Okay. It's the managers who are acting in their own self-interest or their short-term interest. So it's not A. A vocal minority of shareholders expecting directors to act as their agents and pay substantial dividends. No, it has nothing to do with majority minority of shareholders, right? Companies reliant upon substantial government contracts such that they are effectively agents of the government? No, definitely not. The directors acting in their own interest rather than the shareholders' interest. That is correct. The directors taking decisions that will benefit them and not the shareholders. Okay. Right. Second question is saying the following information has been calculated for D company. Raw material inventory. In Shifa, if you have done the paper, you can mark it right now. Okay, so you can mark it along with me walking through the paper. So it should be easy for you. Okay. The following information has been calculated for D company. We have raw material inventory turnover period, work in progress inventory turnover period, trade payables, payment period, finished goods inventory, and trade receivables. So what's the question? They're saying the length of the working capital cash cycle is how much? Okay. So if you want to calculate the working So the working capital cycle, there is an equation. Okay, so we all know that there is an equation. So basically, it is the raw material inventory plus the work in progress inventory plus the finished goods inventory plus the trade receivable collection period. From that, you must deduct the trade payables payment period. Okay, so the ones that I have marked in red, they have to be added, whereas the trade payables payment period has to be deducted. Okay, so that is the equation. So just a matter of doing that. So 19 plus 14 minus 40 plus 31 plus 52. That should give me 76 days. Okay. So always remember, it's what we have to pay, right? The payables is what we have to pay now. So that is the figure that will be deducted. Everything else has to be added. Okay. Right. Okay, so most of you have actually attempted it. So I can go ahead at this pace, right? Then it says the purchase price of an inventory item is 42 dollars per unit. In each 3-month period, the usage of the item is 2,000. The annual holding cost associated with 1 unit is 5% of the purchase price. They're giving you the EOQ as well. What is the cost of placing an order? Okay. Now, whenever you see a question like this, the best thing to do is write down or, type it in your exam. You have something called a scratch pad, right? So you can open that scratch pad and type down the equation that you will be using in this case. So very clearly, they're talking about the EOQ or the economic order quantity, right? They're talking about the economic order quantity. So before I do anything, what I will do is I will write down that equation. EOQ equals to 2 times the cost of ordering into the demand over the cost of holding. So that is the equation that I have to use. Now what I will do is I will figure out what I already have in the question. Okay. So very clearly they have given me EOQ already. Okay. They have given me purchase price, but I don't really put purchase price directly. Then they have given me usage, right? So what is usage? I'm sure you guys know that. Usage is only the demand. Okay, so demand is also given. Then they're saying the annual holding cost associated with 1 unit is 5% of the purchase price. So this cost of holding is also given. It's 5% of purchase price means that is 5% of 42, right? So everything is given except for one figure, which is this cost of ordering. So most probably that is what they want you to find out, right? So if you look at the question also, it's saying what is the cost of placing an order, right? So that is the figure that you need to find out. Just a matter of rearranging this equation, but you have to be a little careful. Okay, so let's put in the numbers that we know. EOQ is 185. That should equal to the root of 2 times cost of ordering, we don't know, multiplied by demand. Now this demand, guys, I have already told you, this is annual demand. Okay, it is not a monthly demand or a 6 monthly demand or anything. It is annual demand. So if you look here, they're saying 3-month period. In each 3-month period, the usage of the item is 2,000. So that means with every 3 months, the demand is going to be 2,000. So for 3 months, if it is 2,000, for the entire year, it will be 2,000 into 4. Because we have 4 quarters. Over cost of holding, they told me it's 5% into 42. Right? So now you need to rearrange this to get the EOQ. Yeah. Okay, so what you need to do is this root will come on to the other side. 185 will become 185 squared. And then take the answer for 5% of 42, multiply that. And I'm sure you know how to do the rearranging after that, right? So when you do that, you should get the cost of ordering as $4.49. Now, an exam thing you have to remember is they're telling you to give it to 2 decimal places. One of the papers I got, you had given it to 1 decimal place. You had rounded it to 4.5. Okay. In your exam, you might not get the mark if you do that. Because these are all still marked by the system. It's not marked by a person, right? So in the system, they would have only stored 4.49 as an answer. If you put 4.5, you might not get the mark. So please pay attention to these things that they tell within brackets. Okay. So that will be 4.49. You can take this calculation down if you haven't, and make sure you are able to put this equation in your calendar and get the answer. Okay? Did you try it? Haven't the paper?
My studies after finishing and
Okay.
else I don't have the confidence.
So Afzal, Amruti, let me just check who else is there. Yeah, only Afzal and Amruti. Have you guys tried the paper? Because if you haven't, I will go a little slowly. If not, because I know the others have already tried. Yeah, Tarushi, it's not wrong. I mean, now I know it is correct because you can round it up. But like I said, this is marked by the system. It's not marked by the examiner. It's not a human being who is marking it, right? So in the system, they would have saved the answer as 4.49 because they have told you clearly, two decimal places. So if you don't put it to 2 decimal places, you will not get the mark because the system won't recognize it as an answer. So yeah, it's wrong. You won't get your 2 marks. Okay, so be careful. You did half the paper. So if there are any of you who haven't done it, you can try it now. I'll give you a few minutes, maybe about 2 minutes before I attempt the question. So you are not completely lost. Okay. So always, Tarushi, only in section C, rounding won't be a problem. Okay, because in section C, anyway, it's marked by the examiner. He can see how much you have rounded to, so no problem. But when it comes to section A and B, you have to pay attention to what they're saying within brackets. Okay, they will always be very specific. 2 decimal places or 1 decimal places or the whole number, whatever it is. Okay. Right. So the fourth is saying a company is planning to open a new store in a new geographic location. An initial site evaluation has taken place at a cost of 7,000 and a store location has been found. Okay. So they're trying to open a new store somewhere and they have spent 7,000 as an initial site evaluation. Now tell me, this 7,000, I haven't even read the question, but I'm just asking you, is it relevant? No, because this is what we call a sunk cost. Okay, it's already sunk. You have already, incurred that cost. Now, even if you don't open the new location, you can't get the 7,000 back. Okay, so you have to forget about it. Okay. The new store can be rented for 7,500 per annum. It will require refurbishment at a cost of 310,000. Then they're saying complete the following statements of the following costs, and they're giving you different options, which is relevant for an NPV calculation. Okay, so I already told you the 7,000 is sunk. So that is not relevant. Relevant means it has to be future, incremental, cash flow. These 3 things has to be there. Okay. So if you look at the 7,500, it is the rent cost. Okay. So definitely something that you will incur in the future. Is it incremental? Incremental means will you incur this only if you go for the new shop? That is true. If you don't go and rent the new building, you don't have to pay 7,500. No. So it is incremental and it is a cash flow as well. So yes, 7,500 is relevant. And then they're saying there's a refurbishment of 310,000. Again, it is future incremental. It is a cash flow as well. So that is also relevant. So 2 and 3 should be the answer. Okay. Okay. Fifth is saying complete the following statements of the following ratios. And they're giving you the options which would be used to assess the liquidity of a company. Take a look. What do you think talks about liquidity? So we have return on capital employed, gross profit percentage, acid test ratio, and the gearing ratio. Okay, good. So ROCE and gross profit percentage, we all know is to do with profitability. Acid test ratio, we do know that it's also called the quick ratio. It is to do with liquidity. Gearing ratio is to do with risk. Okay, so they are asking me which would assess liquidity of the company, only the acid test ratios, that is 3. Okay. Right, so now they're giving you a graph. Can you tell me what this graph is actually about? We have seen this before. Can somebody tell me what this graph is about? They have given you no clue. They have not told you what it's talking about or where in the syllabus this graph comes or anything like that. They're just giving you the graph and asking you to correctly label it. So if you don't know that area, you will be lost, right? Where did we see a graph like this? I can help you a little. This dotted line only usually is the WACC. Where did we see a graph like this? Okay, which area? Correct. Purchasing power parity arrangement. Okay. So some of you are saying cost of capital and I'm getting other answers as well. This is the traditional view of capital structures. Okay. So please make sure you learn these areas. Okay. If you don't know where this is coming from, that means you haven't gone through this particular chapter, right? So in the traditional view, we said this is going to be the cost of debt. One will be the cost of equity, okay, and 2 is only the weighted average cost of capital, okay. So which of the following correctly labels the lines on the above graph? 1 has to be KE, 2 has to be WACC, 3 has to be KD. So the answer there is clearly A. Okay, so what did this theory say? It said that the more debt you take, the WACC will keep on falling because debt is cheaper than equity. But after a particular point, because risk is high when debt is very, in exceptionally high levels, cost of equity also starts rising. So at that point, the WACC starts coming up. Okay. So initially, as you increase your debt, WACC will drop because debt is cheaper than equity. But the moment your debt comes to a point where, you're 60%, 70% in debt, you're heavily in debt, what happens? The shareholders, they kind of perceive that company to be risky. So they start demanding a higher return. So the moment they start demanding the higher return, KE increases. And as a result, this WACC also starts to rise. Okay, so the point is, we say we have to find this optimal point because at this point only, the WACC is minimized. So you have to find out what is that proportion of debt and equity where WACC is minimized and maintain that for your company. Okay. Right. 7th is saying a government is looking at assessing hospitals by reference to a range of both financial and non-financial factors, one of which is survival rates for heart bypass operation. Okay, so what are they talking about? They're talking about survival rates. Okay. Complete the following statements. Of the 3 E's, economy, efficiency, effectiveness, externality. Now, first of all, you can cut off externality because we know that is not an E. It's either economy, efficiency, or effectiveness, right? So, of the 3 E's, which best describes the above measure? So, survival rate, is it economy, efficiency, or effectiveness? What do you think? Survival rate. Okay, good. Economy is to do with minimizing your cost. Okay, now survival and cost is 2 different things, right? So definitely not economy. Efficiency is making the maximum out of the input that you're putting. So for example, if you have a doctor, he is coming for 10 hours, make sure that you get the maximum out of that 10 hours. That is efficiency. So that is also not necessarily what survival rates is about. What is effectiveness? They're saying the output of that particular organization should be in line with the overall objective of the company. Now, if you take a hospital, Okay, end of the day, the major objective is what people who come do operation they should survive, right? If they don't survive, no matter how cheap you are giving the operation, no matter how good your rooms are, all of that doesn't matter if the people are going to come and die, right? So survival rate is definitely one of the main objectives when it comes to a hospital. So this is definitely effectiveness. Okay, so that's how you should be able to figure out which one it will be. Okay. That's effectiveness. The government in a country is following an expansionary fiscal policy. Okay, so fiscal policy means what? We are going to do something with taxes and public spending. That's only fiscal policy. Expansionary means what? We are trying to increase whatever we are trying to do. Okay, so it has to become bigger than what it is, right? So we'll see what it says. How might this affect many businesses? So they talk about a fiscal policy. A is saying higher taxes, less government contracts being offered, less subsidies and lower demand. Now, since they're talking about taxes, definitely this has something to do with the fiscal policy. But is it expansionary? Are we making the economy bigger? Are we, kind of increasing the supply in that particular economy? If you ask companies to pay higher tax, you're not going to give them contracts, less subsidies, lower demand. That means the economy is actually contracting. It's not expanding, right? So they are talking about expansionary policy. This is a contractionary policy. So can't be A. Okay. B is saying lower interest rate. The moment you see interest rate, we are talking about the monetary policy. So that is definitely out. Okay, so definitely out. C is saying lower taxes, increased government subsidies and contracts being offered and a higher demand. So again, it has something to do with taxes. So yeah, we are still on fiscal policy. That's fine. And we are lowering the tax. So what happens? Companies, they have more disposable income. So at that point, they will be able to invest more. They'll be able to, expand whatever operations they're doing. So this is what we call an expansionary fiscal policy. So that will be the answer. D is again talking about interest rates, which is the monetary policy. Okay. Which two of the following are false regarding simulations? Okay, so if you remember what's a simulation, it is kind of like a prediction. We are trying to predict what's going to happen in the future, but by changing different variables. Okay, so we see, okay, what will happen if sales and costs increase? Okay, what will happen if maybe a fixed cost suddenly reduces? Okay, what will happen if interest rate increases? So we will take so many variables that can change at the same time and try to predict what's going to happen in the future. So that is only a simulation. So they're saying which two of the following are false regarding simulations? What do you think is the answer? What do you think is false? Okay. So A is saying they can consider several variables changing simultaneously. That is true. Okay, when it comes to simulation, the advantage is that you can change many variables at the same time and try to see what's happening. This is a disadvantage when it comes to sensitivity analysis. Okay, in sensitivity analysis, you can't, change many variables. You can only change one at a time. Whereas with simulations, you can change many variables. So that is true. They have a clear decision rule. Okay, now simulation, guys, it can predict and say this is what will happen in the future. But it can't say this is the decision you should take as a result. Decision making is at the discretion of the person. Okay, the person who is carrying out the simulation, he has to take the decision based on his knowledge. So the system itself doesn't give you a correct answer. Now compare that with something like NPV. NPV means if it is positive, the model itself is telling accept. right? Whereas here, it's not clear cut like that. It doesn't tell you whether to accept or reject. It's up to you to decide whether you're going to accept or reject or do something about that particular project. Okay. So B is actually false. It doesn't have a clear decision rule. So that is one false statement. C is saying they give a better understanding of risk. That is actually true. Okay, because risk is what? Variation. Okay, when it comes to simulation, we try to see how so many variables are going to change, how they are going to vary. So yes, it does give you a better understanding when it comes to risk. Okay. D is saying they remove the need for management judgment in decision making. That is wrong. I told you again, management judgment has to be there because the system doesn't tell you what is right and what is wrong. It will just tell you this can happen. It's up to the management only to decide, okay, are we going to go ahead with this project or is it too risky for us? That is up to them to decide, right? So it doesn't, remove the need for them to put in their expertise. So D is wrong. E is saying they describe a range and probability of possible outcomes. That is true. Okay. So the only two false statements there will be B and D. Okay. 10 is saying, which of the following is the correct statement of the conclusion of Modigliani and Miller on the relevance of dividend policy? There was a chapter where we spoke entirely about dividend policy. We said there were three theories. One was irrelevancy, relevancy theory, okay, and the residual theory. Okay, so you can have a look, if you want, have a look now and see what Modigliani and Miller spoke about when it came to the relevance of dividend policy. So at this point itself, you should realize that they have given, in this particular paper at least, they have given a lot of weightage for theory. And we have come through 10 questions, 20 marks we have already answered now. Almost, I think only one was a calculation, right? That EOQ. Other than that, everything else was based on theory, right? So when it comes to FM, guys, calculations are important, but that mostly comes in section C. A and B more or less is something to do with theory only. Okay, so don't underestimate theory. That's all I will have to say. Okay. So which of the following is the correct statement with regard to relevance? Okay, so there are three theories. I'll just quickly summarize it for you. Irrelevancy, dividend irrelevancy theory, what it suggests is they say whether you give a dividend or whether you don't give a dividend, doesn't matter. As long as the company is doing well, shareholders are happy. Okay, why? Because if they want money, they will sell their shares and even get that money. If they don't want money and you give them a dividend, they will invest that again in shares. So if they want money, they know how to get it. So it is irrelevant whether you give a dividend or not. Dividend relevancy means we say whatever you're doing, you have to stick to that because of the clientele effect. Okay, because of the dividend signaling. So if you give $100 dividend every year, you need to stick to that. You can't suddenly make it 1,000 one year, make it 500 another year. Okay, that is relevancy. Residual theory is, it says after you have invested in all positive NPV projects, whatever is remaining, you can give it as a dividend. Okay, so let's see which one is talking about relevance. A is saying increase in retentions result in higher growth rate. This has nothing to do with the dividend theory, but what is this theory? Where they say the more you retain, the more you grow. This is Gordon's growth. Okay, Gordon's growth, G equals BR. Let's say that the more you retain, the more the company will grow. Okay. B is saying all shareholders are indifferent between receiving dividend income and capital gains. This is dividend irrelevancy. They don't care whether it is dividend or capital gain. As long as they're getting a profit, they're fine. So that is not relevant. So that is wrong. The value of the shareholders' equity is determined solely by the firm's investment selection criteria. That is true. Even if you're giving a small dividend, they don't mind as long as you're properly investing in positive NPV projects. If you're not investing and you're not giving a dividend also, then there is a problem, right? So this is part of the relevancy theory. D is saying discounting the dividends is not an appropriate way to value the firm's equity. They don't talk about that in the dividend policies. Okay, that is completely out. So the answer there will be C. Right, so 11 is a calculation. You can try it out, something to do with the purchasing power parity theory. Right, since some of you haven't. Okay, so it says here, inflation in the UK is 5% per annum and in the US it's 6% per annum. Given that the spot rate is currently £1 equals to $1.5, what will a UK company have to pay in sterling in 12 months' time to buy a commodity costing $10,000? So if I have to know in 12 months how much pounds I will have to pay, I have to first of all know what will be the exchange rate in 12 months. Today I know it is 1.5. Okay, but in 12 months, how much will it be, right? So the future spot rate, I can calculate it using the purchasing power parity theory. Again, inflation. Okay, so the future spot rate S1 will equal to the current spot rate, which is 1.5 into 1 plus inflation in the counter currency. So we are based in UK, counter currency is the US. In the US, inflation was 6%. Over 1 plus inflation in the base currency, which is our country. In the UK, it is 5%. Okay, so that will give me the future spot rate, which is 1.514. So that will be the spot rate in 12 months' time. So if I have to pay $10,000, how much will that be in pounds? It will be 10,000 divided by this 1.5143. So in pounds, I will end up paying 6,600. Here also careful, they're saying answer to the nearest Great British pound. So you don't have to put decimals, right? So it will be 660. Okay. Take it down if you haven't. So guys, it's high time you all started questions. Okay, because no matter how much you study, it won't help. Okay, after you study also, there will be much more to learn from the papers. The base that you get from the studying, you have to get over with that very quickly. The more time you spend studying, the less time you're going to get doing papers. With FM, papers is only key.
What papers to do study or study exam?
Whichever one you're comfortable with. Now, the thing is, study hub, you don't have that many MCQs. Okay, so either way, whatever you do, that is up to whichever one you're comfortable with. But the point is, you need to start the papers. Okay, because don't think that after you've properly finished studying, you will be able to do the papers 100% properly. You won't. You will find so many problems. So you need time to sort out those problems. So no matter how hard you study, no matter how well you know all the theories, when it comes to the papers, the way they question is different no end of the day. Okay, so even if you have half studied, it's okay, but you can't half do the papers and go for the exam. You will be completely lost. Okay, so get over with the studying as fast as possible. Even if you have to look at the book and answer, I don't mind. At one point, it will stick to your head. But questions, you have to break that fear. Because this batch, honestly, I have seen that where all of you have a fear to start the question. Okay, don't have that fear. If it's wrong, you tear the page and start again. That's about it, right? But don't have the fear to start the question, because then when are you going to break that? After you break that only, you can even think of, learning from the question. Okay, because trust me, there is a lot to learn from the papers, not from the study text or the book or the slides or whatever. The papers only will teach you more. So for that, you have to give it enough time. If you don't do that, you will end up only doing half. You will only know about 60% of the syllabus. You will have to go to the exam and figure out the other 40%. This is a bad situation to be in. Okay, so get this over with. Papers have to start immediately. In fact, I feel it's a little too late at this point also. Okay, so it's 10 days after now November, 10 days are gone. You only have about 20 remaining. So make sure you use that time properly and start off your papers. Don't be scared if a question is wrong. If it's wrong, you can learn how to make it correct. But until you break that barrier, until you start the question, you're not going to learn from that particular question. Okay? Right. So we have the 12th one. Which of the following best describes Murabaha as a source of finance within the Islamic banking model? Okay, so Murabaha, if you remember, it is trade credit. Okay, it's trade credit. It's like taking a loan. Okay, so it says a form of equivalent trade credit or loan. That is only Murabaha. Very straightforward. If you knew that particular area, this is just an easy 2 marks. An equivalent of lease finance is actually Ijara. A special kind of partnership where one partner gives money to another for investing in a commercial enterprise. So this is a situation where there are 2 partners. One partner is giving money, the other partner is giving his expertise. Okay. So if you remember, this is actually called Mudaraba. So don't confuse the terms, right? Because they asked for Murabaha, not Mudaraba. So sometimes you might, use it interchangeably, which is wrong. So see, they're talking about Mudaraba. D is saying a relationship between 2 or more parties who contribute capital to a business and divide the net profit and loss pro rata. Okay. Now remember, in Mudaraba, one person gives 100% of the finance, the other person is going to run the business on behalf of him. Right. But when it comes to Musharaka, both parties will contribute some particular percentage when it comes to capital. Okay. So this is Musharaka. I know everything starts with M. Okay, so that is Musharaka. It is the equivalent of venture capital. Okay, so anyway, the question is asking for Murabaha. So that is going to be straightforward. It's A. Okay. Right. 13 is saying, comment on the validity of the following statements in relation to the efficient market hypothesis. What do you think is the answer there? So when it comes to efficient market hypothesis, there are different kinds of markets. We have inefficient market. Then we have a weak form efficient market, semi-strong, and strong. Okay, so we went through this, I think, at the very beginning of our syllabus, right? So let's read through. Statement 1 is saying an inefficient market is one in which the value of securities is not always an accurate reflection of all the available information. That is true. Okay, if you are inefficient, the share price is not reflecting the information that is available properly. Okay, so that is only the inefficient market. Statement 2 is saying in a semi-strong firm market, the share price incorporates all past information and all publicly available information. That is also true. When it comes to semi-strong firm market, we are going to reflect past information and public information. Strong means past information, public information plus private information. Okay. So semi-strong form, what they're saying is correct. So both statements seem to be true, which is A. Okay. So inefficient means it's not reflecting any information. Weak means only it reflects the past information. Semi-strong means it reflects past plus public information. Strong means past, public, private, everything is reflected. Okay. So that will be A there. So 14th is to do with expected values. Okay, you can try it and see if you can get the answer. It's saying using expected values, which one of the following would you recommend for DPLC? So you should first of all get the expected value. After that, we can decide which one is the better project or product in this case. Try it out. So throughout in section A, we have only had 3 calculations. One was an EOQ, the other one was a purchasing power parity, and now an expected values. Other than that, everything else has been theory. Okay, so it says here, DPLC is considering whether to make product X or product Y. So he can either make product X or product Y. The production of the products is mutually exclusive because they use the same machinery. So if you do X, you can't do Y. If you do Y, you can't do X. One of the two, you have to decide. The estimated sales demand for each product is uncertain, and the following probability distribution of the NPVs for each product has been identified. So they're giving you the NPV and they're giving you the probability of getting that NPV as well. Okay, so they're saying product X, the NPV can be 3,000 and the probability is 10%. or it can be 3,500 and the probability is 20% or 4,000, and it goes on like that. Likewise, the product Y also, they're giving you the NPV and the probability. Using expected values, which one of the following would you recommend for DPLC? So let me get the expected values first. How do you do that? You have the NPV and, right? So I have told you whenever you're doing expected values, when you're using the word and, you have to multiply, right? So it will be 3,000 into 10%, 3,520%, 4,000, 4,500 and 5,000. All you have to multiply with the probabilities. Right. So 3,000 into 10% will be 300. I'll give me a minute. Put it as expected value. 3,000 into 10 will be 300. 3,500 into 20% will be 700. 4,000 into 40% will be 1,600. 4,500 into 20% will be 900. And 5,000 into 10% is 500. So the total expected value for product X, you can add it up, it will be 4,000. Okay. So same thing you need to do for product Y as well. 2,000 into 5% will be 100. 3,000 into 10% will be 300. 4,000 into 40% will be 1,600. 5,000 into 25% will be 1,250. And 6,000 into 20% will be 1,200. So you can get a total here, which is 4,450. Okay, so one is 4,000, the other one is 4,450. According to expected value, you should go for the higher option. So you will choose product Y, which is B. Simple. Okay. Right. So if you have taken it down, you can try out the 15th one, the last one. All of the following that can be manipulated to affect the monetary policy except which two? It's about monetary policy. Inchika, did you send me the paper? Or, did I somehow miss it? You have sent it, or you have emailed it to me, is it? So I don't have it, Inchika. When did you send it to me? It's not really BN. Okay, anyways, once you're done marking, let me know, okay, how much you get. Okay. Right, so they're saying all of the following are variables that can be manipulated to affect the monetary policy except which two. So if you're talking about monetary policy, we're talking about money supply. And we're talking about interest rates, right? So anything that is not to do with money supply and interest rates, it's the answer, okay? So A is saying credit restrictions achieved via the banking system. If there is a restriction, you're restricting the money supply. So you are restricting the monetary policy. So that is correct. Government expenditure on goods and services, we all know that is a fiscal measure. That's fiscal policy, right? So government expenditure definitely cannot be manipulated if you're going to affect the monetary policy. So B will be an answer. Volume of money in circulation, that is also part of monetary policy. The rate of interest also part of monetary policy. Taxation is part of fiscal. So B and E is actually fiscal. So that's why it is the answer. Okay. Right. So that is it for section A. It will be like the short questions most of the time, focusing on the theory-based area. So by the time you're done with this, you won't even be tired in your exam. That's why I told you, try to do it in the order that the examiner is giving you, because you wouldn't have, broken your head too much. Easy 30 marks you would have somehow been able to get. So if you can get somewhere between 20 to 30, you're good. Okay. Right. So section B, basically you have 3 questions. Okay. You will have 3 questions. And most of the time, I'm not telling you it's going to happen always. Most of the time, one of them will be from risk management. Risk management means foreign exchange and interest rate risk. Why is that the case? Because they can't ask much to do with risk management in section A because it's a little lengthy. But they can't ask in section C also because they have told us they won't ask. Okay. So the only area where they can ask a little bit of risk management is section B. So you can expect one full question to come from that particular area. Other than that, anything can be tested. Investment appraisal can come, cost of capital, business valuation, anything can come. Okay. Right. So it says here, section B, all 15 questions are compulsory and must be attempted. Each question is worth 2 marks. So 3 major questions, each question is worth 10. Inside that, in every question, you will have 5 smaller questions and each of them will be worth 2 marks. Okay. Right. So I'll give you a minute, go through this scenario and then we will attempt it. Okay. So from the answers I saw, section B wasn't as, in terms compared to section A, it wasn't as good when it came to your answers. Yes. So this question is clearly from working capital management. Okay, go through it. I'll give you maybe about 5-10 minutes. Go through it and see if you can get your answers. And then I will discuss. Okay, so let me read through what it says. It says Jacob Limited has decided that it needs to improve its cash position. The finance manager has targeted a reduction in the time taken for customers to pay and is considering various options. Okay, so if you want to improve your cash position, one thing is tell your customers to pay early. So that's what they're trying to do. It currently has a 4.5 million balance on receivables and a 82-day average time period for receipt of cash from customers, right? So currently, what is my receivables balance? 4.5 million. And the receivable days is 82 days. That is the average time period. So receivables and receivable days I have. Its annual sales is 20 million. Obviously, I will need that figure. And the business has an overdraft currently charging a rate of 8%. That means the current interest that you're paying is 8%. Okay. So this is the current situation. An invoice discounter offers to help JCO collect cash faster for a fee. They promise that with their help, 60% of the sales will be collected in 30 days and the remainder in 60 days. Now, usually it takes me 82 days to collect my money, right? But now this invoice discounter, he's coming and saying 60% of the sales value I will get in 30 days. The remaining 40% I will get in 60 days. So, overall, the entire sales, I'm getting it earlier than what I am currently getting. Okay. JCO is also considering using the offer of a settlement discount to customers to encourage them to pay more quickly. Customers will receive the discount if they pay in 30 days. So they have two options. Either go with the invoice discounter. He will make sure that everything is paid within 30 or 60 days. Or they can go for another option, which is to give the customers a discount. And tell them if they pay early, within 30 days, if they pay, they will get a discount. That will kind of provoke the customer to give the money quickly. JCO's other option under consideration is to use a debt factor agency. So, three options. One is go for an invoice discounter. Two, go for an early settlement discount. Three, go for a debt factor. So, they have to decide which one works well for that particular scenario. Okay. So 16 is asking what would be the annual saving in the cost of financing. Cost of financing means it's the interest cost. If the business could reduce its receivables by half and at the same time move to a better overdraft with a rate of 6%. Okay. Now they're saying currently you have an interest that you're paying. Calculate that somehow. Then they're saying, suppose I reduce my receivables by half, so it's 4.5 now, it becomes half of that, and I get a better interest rate of 6%. Then obviously the interest charge is different now. Then they're saying, compare the new interest with the old interest and see how much you're saving if you could strike this deal. Okay, so two steps here. One, you have to find out what is the current interest rate for the overdraft. Second, you have to find out what will be the new interest that you're paying if what they are mentioning happens. Okay, so try it out and see if you can get the two figures. I don't think anybody got this answer. Okay, so your current receivables is 4.5 million. They have not paid you, right? Now, because they didn't pay you only, you had to go for an overdraft. Okay, so that entire 4.5 million currently, you will have to take an overdraft and you will have to pay an interest on that overdraft of 8%. Okay, so your interest cost currently is 360,000. Okay. So why did you take the overdraft? Because their receivables didn't pay you. How much was the receivable balance? 4.5 million. Okay. Now let's see what happens in the new scenario. So new overdraft. So they're saying, what would be the annual savings if the business could reduce its receivables by half? So this 4.5 million, you have to reduce it by half. So only 50% I have to take. And you're going to move to a better overdraft rate of 6%. So all this while we were calculating based on 8%. They're saying we can get an overdraft rate of 6%. Okay, so 4.5 into 50% into 6%. The new interest will be 135,000. So earlier I used to pay 360. Now I'm paying 135. The net savings is basically the deduction of the two figures. So 360,000 minus 135,000, 225,000. That is only the savings. Okay, it's a simple question. You just have to have the courage to start. Okay. Take it down because I have to erase that before I do the next one. Okay. Right. So 17 is saying, what would Jayco's new average receivable balance be to the nearest 1,000 if it used the invoice discounter and cash came in at 30 and 60 days as promised? So they're talking about this situation, this invoice discounter story. Okay. So what did the invoice discounter tell? He told me that 60% of the sales will come in 30 days, remainder will come in 60 days. Okay. Now they're asking me what will be the receivables figure. Now, receivable days figure is easy for me. 60% into sales, sorry, 60% will give in 30, 40% will give in 60. I know how the receivable days will be. Okay. But what is going to be difficult is to find the receivables figure. So, how do I go about that, right? So, again, there is an equation like this, right? I'm sure all of you know it. Okay, so there is an equation that goes like this. Yeah. So we know that receivable days equals to the receivables over the sales into 365. That's how we calculate receivable days, right? Just give me 1 second. Hello? Yes. Yeah, it's a way. Sorry about that. So I have the receivable days, that will be receivables over sales into 365, right? Now they are asking me for receivables. So what I can do is I can rearrange this equation. Okay. So what I will do is I will make receivables the subject of the formula. So receivables will equal to the receivable days over 365 into sales. Because I am just rearranging the equation. Into sales. Okay. Now, if I can use this equation to try to figure out the, what do you call, the new receivables, that is basically my answer. Okay. Now, the thing is, when it comes to these receivable days, there were 2 days. One was 30 and another one was 60. So now what I have to do is I have to find the receivables when they give it to me in 30 days and the receivables who's going to give it to me in 60 days. So there will be 2 separate calculations. Okay. So let me do it one by one. So one is the 30-day receivables and the other one is the 60-day receivables, right? So for 30 days, what will the receivable days be? Obviously, it will be 30 into what is the sales figure? In the question, they give me the sales as 20 million. So into the sales, which is 20 million, into what percentage will give me that 20 million in 30 days? They told me 60% of my sales only will come in 30 days. So that will be 60% over 365, right? So 30 over 365 into the sales figure, which is 20 million into 60%. So that should give me the receivables in 30 days. Okay. So put that in your cal. You should get 986,301. Okay. So same thing you need to do for 60 days as well. You can try it out and see. Okay, so if you look at the 60-day cycle, receivable days will obviously be 60 in this case. Sales will be 40%, right? So 20 million into 40% over 365. So that should give you the new receivables balance. It should be 1.315068. $1,315,068. Yes, I'm just rearranging the equation because I have receivable days. I can find the receivables figure that they asked. So then what was the question? They're asking new average receivables flow. So just a matter of adding these two together. Okay, so that will be 986,301 plus 1,315,068, which will give me 2,301,369. They told me to the nearest 1,000. So, yeah, the closest answer that we have is 2,301,000. Answer is already there. It's just a matter of selecting. Okay, is it clear how you got it? Got it? Okay. So answer is B. 18th is saying, complete the following statements the effective annualized cost to one decimal place. So again, one decimal place means you have to give it to that 1 dp of Jayco offering a 1% discount to their customers, and all customers took up the offer would be how much? So they're saying, what is the annual cost if this company gives a 1% discount and all their customers took up that discount? So when all the customers take up the discount, if you remember, there is an equation that you can use to get your annualized cost. If 60% took it up, 40% took it up, you have to do cost versus benefit analysis, right? But here, since everybody has taken it up, we don't have to worry. You can directly use the equation itself. So the equation goes like this. The annual cost equals to, if you remember, 1 plus the discount over the amount left to pay to the power of the number of periods minus 1. Okay. How do we calculate the number of periods? It's part of the slides, right? You can either use months or days or weeks, but in this case, I think they're talking entirely in terms of days, right? So we will have to use days. So it will be 365 over number of days earlier the cash is received. Okay. So first thing is you need to calculate the number of periods, right? So that will be 365 divided by the number of days earlier the cash is received. So if you look at the discount, they're saying Jayco is considering using a settlement discount to encourage them to pay more quickly. They will receive the discount if they paid in 30 days. So earlier they were taking 82 days to pay. Now they're going to pay in 30 days. So how many days earlier are they paying? 82 minus 30. Okay. So that will be 82 minus 30, which is 7.0. So now we have the number of periods, just a matter of putting it in the main equation. Okay, so I'll do that over here. 1 plus discount was 1% over amount left to pay. You can consider a $100 invoice. So in a $100 invoice, if $1 is a discount, you have 99 left to pay. Over number of periods is 7.02 minus 1. So that should give me the annual cost. It will be 7.3. Okay. So the key here is that they told me everybody took up the discount. If they didn't tell me that, it wouldn't have been as easy. Okay. You can take it down because I think most of you didn't get this. With the 18th. Okay. Okay. Right. So let's look at the 19th one over there. Which of the following is not true about debt factoring? Okay. So debt factoring is where another company will take up the credit control of our company. So they will call our customers. They will make sure that they pay on time. Okay. So A is saying debt factors can take over the credit control function. That is true. Basically, one of the things that they do is they take over the admin part when it comes to debts. So that is actually true. It's not true. So that can't be an answer. Customers will be unaware that the supplier uses a debt factor. Is that true or false? If you're going for debt factoring, will your customers know that a debt factor is now involved? They will know. Okay. Invoice discounting, they won't know because you deal with the invoice discounter, take the money in advance, you finish off the deal with the invoice discounter. But when it comes to factoring, it's not like that. The moment the factor takes over, the factor will start calling your customers. Okay. So what happens? Customer has to deal directly with the factor and not you anymore. So that is actually true. So here they are saying customers are unaware, which is false. They will become aware of the fact that a factor is now involved. So that is the answer. Right. Let's see the others. Factors can take responsibility for unpaid debts under non-recourse arrangement. That's true. You can get insurance as well from factoring. Factors can offer credit insurance. Yes. Okay. So that is all correct. The only thing that's wrong is B. 20th one, which of these is not a key aspect of credit policy? So when it came to credit policy, there were 4 different things that you have to look at. Let's look at what they're saying here. Setting credit limit for customers, that is part of credit policy. Invoice promptly and collect overdue debts, that is also part of the credit policy. Offer discounts to speed up cash receipts. Offering discounts is not part of credit policy. Okay. Assessing creditworthiness is also part of credit policy. So the only thing that is out is C. Okay. So you have to go through that. There were 4 things that we spoke about. One was say doing a creditworthiness, then setting credit limits, invoicing promptly, and finally making sure that every now and then you keep on rechecking and making sure that the customer is still creditworthy. Okay. Right. So that is that. Okay. So now if you look at the next question, when I look at it itself, I can see that it has something to do with business valuations. Okay. Because they're giving me ordinary shares, earnings per share. Okay. Then I can see a lot of dividend rates. There's a VAT. Okay. So go through what they're saying. 21 is asking you for a suitable earnings figure. So definitely something to do with that business valuation area. Okay. This particular area, again and again, I'm telling you, only if you do questions, you will get the hang of it. Okay. Because the way they teach it is different. The way they question it is a little different. So the more questions you do only, you will get comfortable with this particular area. Okay. I have a quick read through and then we'll do the questions. It looks difficult. It's a very easy question. Okay, it might look difficult. It's a very, very easy question. Okay, so let me read through. Saying AJP company is an unlisted company. Okay. The owner and manager of the business is approaching retirement and is considering the sale of his business. Okay. So all these days it has been like a sole trader. Okay. There is one owner. He is only running the business also, but now he's going to sell the business. Okay. Financial information is as follows. We have 5,000 ordinary shares. Latest earnings per share, the EPS is given $7. Estimated equity beta 1.5. Latest free cash flow available to the owner is 33,000. That means after all the costs have been settled, 33,000 pounds is available for the owner or the shareholder. But be careful, they're saying it's after salary payment. Okay. Now for him, his salary is also considered part of the cost because he was the manager now. Okay. But suppose he was a normal shareholder, he was not a manager, then whatever salary component also will be considered part of the cash flow because then that will be added to this 33,000. Okay. So it says here the owner and manager pays himself an annual salary of 200,000, which is 60,000 more than could be reasonably expected for such a role. Now, if I take another manager and make him do the job of this owner, I will pay him only 140,000. Okay, I will only pay him 140,000 per year. But here, because the owner and the manager is the same, he is taking a little extra. He is taking 60,000 more. So, this 60,000 actually belongs to the shareholder in future. Because in the future, we won't pay this amount. We will only pay 140,000. Okay. Other relevant information. Range of listed company PE ratios for companies in this sector. So I have told you, when you are doing business valuation using the PE ratio method, you have to take a proxy company's PE ratio if it is unlisted. Because unlisted companies don't have a market price per share. Okay, so they are telling me similar companies' PE ratio will be within this range. Then we have the dividends just paid as $2.1 per share. Next year's planned dividend is 2.205 per share. Tax rate is 30%, WACC is 9%, and the cost of equity finance, that is KE, is 12%. Okay. They're saying 21, what would be a suitable earnings figure to use for business valuation based on the PE ratio? Okay. Now, tell me, can I use 33? Now, earnings means what? The amount that is available for ordinary shareholders. They're telling me free cash flow available to the owner is 33,000. Can I use that as the suitable earnings figure? Do you think that 33,000 can be used as a suitable earnings figure or not? You can't, right? You obviously can't because that is the latest free cash flow available to the owner after a salary payment. So this salary itself is a little bit of a mess, right? So we have to do this from scratch again. Okay. So what we will do is based on the earnings per share, which is $7, let me get the earnings for the entire shareholding. Okay. So first let me calculate earnings. How will I do that? I will take the EPS and multiply that by the number of shares. So EPS is 7. Number of shares is 5,000. So that will be 7 into 5,000, which is 35,000. Yeah, 35,000. Is that the earnings? Still, we haven't considered the fact that 60,000 was paid more. Okay. Now, after this, in future, after he sells the business, he won't be paying 200,000. He will pay 60,000 less. Only 140,000 will be paid. So, this 60,000 will also reach the ordinary shareholder, right? So, 60,000, you have to add it to the earnings, but be careful. You can't just add 60,000 over here. Why? Because there was a tax impact that would have got created over here. If you paid 60,000 extra, you would have actually saved on taxation. So we can't forget about that impact. So let's take the after tax impact of this 60,000. Okay, so I'll take it over here. 60,000 into 1 minus the tax rate, which is 30%. So the actual benefit is only 70%, which will be 42,000. So this 42,000 in future, it will reach the ordinary shareholder. So in addition to this 35, I can add this 42 as well. So 35,000 plus 42,000 will be 77,000. So that will be the earnings figure. Okay, take it down. It was not given directly.
When are we deducting 60,000?
Which 60,000 am I deducting? Adding.
200,000 minus 60,000.
Because now say you were the owner of the business. You were paying yourself 200,000. But now after you sell, now somebody else will buy, that person won't be the owner. No? He won't be the manager. No? So he will take another person and hire him as the manager. Now that person's salary, we won't give the same 200,000. Earlier I gave it to you because you're the owner, you can decide. But in future, we won't give 60,000 extra because you can see they're saying 60,000 is more than could be reasonably expected for such a role. So the new person who comes in, we will give him maximum 140,000 because that's the market rate. So the remaining 60 will end up going to the shareholder. It won't come as a salary for the manager. Okay? Right. 22. If after taking other factors into consideration, they're saying suitable earnings figure of 50,000 is determined. So I know the actual earnings is 77,000, but they are asking me to use 50,000. So here the advantage is, even if in the previous question you were stuck, you're not carrying forward any answer to number 22. You can just continue because they have given you a figure to assume. So 50,000 is the earnings figure. Consideration. I'll read again. If after taking other factors into consideration, a suitable earnings figure of 50,000 is determined and unlisted companies are generally to be considered 20% less valuable than listed ones, estimate the total value using the PE method. Okay. Now, if you're going to use PE ratio, the market value will equal to the PE ratio into the earnings figure. That's the equation. No? I hope you agree with me. Okay. Now, earnings, they have already told me it is 50,000. PE ratio also they are giving me, it will be between 7 to 11. Okay. So, just a matter of figuring out the actual PE that you're going to use and multiply it with 50,000. Now, whenever you have a range like this, take an average PE. Okay. So, just a matter of taking 7 plus 11, dividing that by 2. So that will be 9. Okay, so if you have a range, if they have given you 9 directly, use it. If they give you a range, then take the average, right? So PE ratio will be 9. So market value will be 9 into the earnings figure, which is 50,000, which is 450,000. But be careful because 9 is the PE ratio of a listed company. So if this company was listed, then the market value will be 450,000. No two words about that. But they are saying usually unlisted companies are 20% less valuable than listed companies. So 450,000 is a listed company. So unlisted means it will be 20% less valuable. So you have to only take 80% of this figure as the market value of this particular unlisted company. So 450,000 into 80%, that will be 360,000. That should come here. Okay. So every part, every line that they're mentioning, you have to focus on it. Because see, this is an answer, no, it's not even an MCQ. If you had just missed that part where, you know, you forgot about that 20% less, your calculations are there. In fact, half of the question you have done, you should ideally get at least 1 mark. But because these are MCQs, you won't even get that 1 mark for half of your calculation. So always read the entire question properly. It's a very simple point here. Okay. So that will be the 22nd one. Right? 23. If valuing a business using asset values, so all this while we were using earnings, right? When it's business valuation, you can either use your assets, you can use earnings, or you can use your cash flows. So now they're saying, suppose we are using asset values, when would a valuation using NRV not be appropriate? Okay. For the seller to use as a maximum price, the moment you see that itself, you should know that is wrong. Okay, because if you are using NRV to value, that is going to give you the minimum price, how much you can actually sell your assets for. So that won't give you the maximum price. Maximum price is actually replacement cost, how much it will cost to set up a similar business from scratch. Okay, so definitely A is not appropriate. The others should be correct. It's saying when the business is not a going concern, because if it's not going to be a going concern, the maximum we can get is the value of the assets. So the net realizable value will be considered fine. Okay. For a purchaser who immediately wants to break up the business after purchase, you don't want to run the business, you're buying it and selling off the assets. We call it asset stripping. Okay. If the business is a property investment company, you're just buying the business because you want the building, you don't want the business. So wherever you purchase a business without having the intention to run it, NRV is a good option to figure out the value of the business. But if you're going to run the business, then it is only the minimum amount because the business itself is working. Okay, so that is why A is not appropriate, because NRV is the minimum price, not the maximum. Go through all of this. We went through it when we were doing the slides. Okay. Right. 24. Calculate the price per share using the dividend valuation model. Okay. So we have done this many times. I'll give you the equation here. Market price of the share should equal to the dividend D naught times 1 plus G over KE minus G. Everything that you need is given in the question. Okay, quickly take down the equation if you don't have it. Can you give me the market price of a share using the data we have here? Dividend valuation model equation is given to you in the Excel. They're asking for the price per share. So they're asking for actually P naught. This is what you have to find. So if you have dividends and growth and KE, it should be relatively straightforward. I think everything is there except for growth. Growth, you have to decide whether you're going to use Gordon's growth model or extrapolating past dividends. Okay. Right. So I have D naught dividend, which they're telling me it's 2.1. I just need to get the growth figure, right? So for growth, clearly I don't have any information to do with Gordon's growth rate, but I have current dividend and next year's dividend. Okay, so some 2 years dividends is given. So I can use the extrapolating past dividends method, right? So what is that? It will be the growth equals to the current dividend D naught over the dividend. 1 minute. Sorry, not D naught. It's actually D1, current dividend over the dividend n years ago. Okay, so I'll just call that D naught over 1 over n minus 1. Okay, now in this case, since it is only 1 year, this n also will be 1. N is the number of years that we're talking about. In this case, it's only 1, so we can completely ignore that. So D1 will be 2.205, next year's dividend, divided by D naught, which is this year's dividend, 2.10 over 1 over 1 minus 1. So the growth will be 0.05, which is 5%. Okay. So usually, careful here, right? You might get confused. Usually in the numerator, we put the current year's dividend. So ideally, we should have put 2.1. But here they are putting next year's dividend because in the normal scenario, we have this year's dividend and maybe a dividend 5 years ago. But here they have given me the information a little differently. They are giving me this year's dividend and next year's dividend. Okay. So because of that, I don't have a choice. For the numerator, I have to put next year's dividend. And the denominator, I have to put this year's dividend because denominator has to be the older figure. Okay. So that's why the future dividend is the numerator and the current dividend is the denominator. Okay. So there's a small change in this particular question. Right. So the growth is there, the dividend is there. Just a matter of putting it into this equation. So dividend was how much? D naught is 2.1. Okay. So let me put it here. 2.1 times 1 plus 5% over KE, which they told me was 12%, minus growth, which is 5%. Put that in your cal, you get P naught, which is $31.5. B. Okay, so the way we calculated growth was a little different in this case. Because why? Because they gave us current year's dividend and next year's dividend. Usually they give current year and the dividend maybe 5 years ago or 4 years ago, which they didn't give in this case. Okay, so that is the 24th one. 25. Complete the following statements. Annual investment in non-current assets or ongoing director salaries or dividends or tax would not be deducted in a calculation of free cash flows. Free cash flow means the amount that is available to ordinary shareholders. Okay. So how do we calculate this figure? We will deduct how much we paid for non-current assets. We will deduct the director's salary. We will deduct tax as well. But we won't deduct dividends. Why? Because dividend is also a figure that is available for ordinary shareholders. Right? So when you're calculating free cash flow, non-current assets, director salary, tax will be deducted. Dividends won't be deducted. So that will be the answer. Okay, because dividend and free cash flow both is available to the ordinary shareholder. Got it? Right, so that is it for this question. So like I said, relatively easy. They could have complicated business valuation, but they've just simply asked you PE ratios and a little bit of the dividend valuation model. Dividend valuation model also, it was straightforward, just a small twist because they gave you the following year. Now, since you did this question, they can't twist it further. Okay, in your exam, either they will give you this way, the next year's dividend, or they will give you the normal way, the previous year's dividend. So it can't get more complicated. Okay. Right. So I told you in this section B, one question will most probably be from risk management. That is this question. You can see it is clearly something to do with foreign exchange. Okay. Read through it and then we'll do the question. Okay. Okay, so it says Zigzag company operates in a country where the home currency is the dollar. Okay, so first fix that in your head. Home currency is the dollar. It has recently begun exporting to a European country and expects to receive 500,000 euros in 6 months' time. So it's going to be a receipt of 500,000 euros in 6 months' time. The company plans to take action to hedge the exchange rate risk arising from its European export. So what's the problem? In 6 months, when you get 500,000, exchange rate might have moved unfavorably. So when you convert it to dollars, you might get less than what we anticipated. Or less or even more. Either way, we don't want that change. We don't like variation. Zigzag could put cash on deposit in the European country at an annual interest rate of 3% per year and borrow at 5% per year. So if you're going to do any dealings in euros, the interest rate for deposits will be 3% and borrowings will be 5%. The company could put cash on deposit in its home currency at an annual interest rate of 4% per year and borrow at 6% per year. Okay, so the deposit and borrowing rates for both the euros as well as dollars is given to you. So clearly, something to do with the money market hedge might come up. Okay. Inflation in the European country is 3%, while inflation in the home country is 4.5%. Okay. The following exchange rates are available to Zigzag. The current spot rate is 2 euros per dollar. The 6-month forward exchange rate is given and the 1-year forward exchange rate is also given. Zigzag is also considering the use of futures or option contracts, but the finance director doesn't feel that she knows enough about them to make an informed decision. Okay, so they have spoken about futures, options, forwards, and by the likes of it, a money market hedge as well. So basically everything to do with foreign exchanges here. So 26 is saying calculate the dollar value received if Zigzag company uses the forward exchange contract. Okay. So we are talking about a 500,000 euros that I will get in 6 months time. So obviously the forward that you're going to use has to be the 6-month forward, right? No point using the 1-year forward. Okay. So let's see how much we will get in dollars for this 500,000 euros if we went for a 6-month forward exchange contract, right? Now we are going to receive 500,000 euros. Tell me, you're in the US. Can you do anything with euros? Do you want the euros? You're going to receive it. You're in the US. Will you want to keep the euros with you? You want, right? You will try to sell the euros to the bank. So that means you are selling means the bank is going to buy from you. The bank always buys at the higher rate. Okay. So if you look here, you have 1.890 and 1.990. The bank will always go for the higher rate, which is 1.990. So 500,000 euros, you have to convert using 1.990. So that will be 500,000 divided by 1.990, which will be $251,256. So that is how much you will get at the end of that 6 months. When you get the 500,000, you have already locked into 1.990. So the bank will have to buy it at that rate. They will give you $251,256. Okay. That's it. Simple. Forwards are always easy. Okay. Then 27 is saying if Zigzag uses a money market hedge, what values will need to be borrowed and deposited today in setting up the hedge? Okay. Whenever they talk about money market hedge, take my advice, do the entire calculation. If not, you will definitely go wrong. If you do bits and pieces in the marking scheme, you will see they're only doing portions. They won't do the entire hedge. But for us, it's better to stick to the entire thing because you won't go wrong. There is no chance for you to go wrong. Even if it takes a minute or two more, it's fine. Okay, it's worth it, right? So let's do a money market hedge here. Okay, so this answer is fine. Right, so if you are going to do a money market hedge, we need to have 2 columns basically, right? We will have today and what is going to happen in 6 months' time. So let me put in the today's first. So we will have a heading saying today and what's going to happen in 6 months' time. Now in 6 months' time, I am going to receive 500,000 euros. Now if I receive, is it an asset or a liability? It's an asset. Then today I have to do the opposite. I have to do what? I will have to create a liability. Okay, you can either deposit. If you deposit, you're creating an asset. Or you can borrow. When you borrow, you're creating a liability. So what I will do is I will borrow. Now I need to borrow euros. Okay, they told me that if you want to deal in the European country, annual interest rate is 3% per year and borrowing rate is 5%. Deposit is 3%, borrowing is 5% per year. So when I'm doing the borrowing here for euros, I have to use the 5%, but careful, into 6/12. Okay, because it is only for 6 months. I'm not going to do it for 1 year. Okay, so I will borrow at ideally 2.5%. So today, basically, I will borrow 500,000 divided by 1 plus 2.5%. The present value only I will borrow. So actually I would have ended up borrowing 487,805 euros. 805. Okay, so today that's how much I have borrowed. Okay. Now, I am based in the US. I can't do anything with the euros. Even if I get this for 87,805, it's of no use to me, right? It's of no use to me. So, I will convert it to my currency. What is my currency? Dollars, right? So, I will convert it today at the spot rate. They told me the spot rate is 2 euros per dollar, right? So, that will be at 2. So 487,805, I will divide it by 2. Okay, so I will get to hand in dollars 243,903, which I will go ahead and deposit into my account. But then I don't have to do this part because that will give me 6 months, right? The question is asking me what will need to be borrowed and deposited today. So everything to do with today, I have already figured it out, right? So I am going to borrow 487,805 euros and I am going to deposit $243,903. So what I'm going to do today is very clearly there in the money market hedge, right? So let's see. Borrow 487,805 euros and deposit 243,903 dollars. So that is answer D there. Okay, because see here the borrowing. Okay, the borrowing is for the euro figure. That's what happens today. And the deposit is for the dollar figure. So you have to make sure you select the correct answer. So today, after this, if you want, you can see what happens in 6 months' time, but that is a waste of time, right? Because they are just for today's portion. Got it? Clear questions? Any questions online, guys? I've done the money market hedge. It says that usually we will compare this figure that we get in the 6 months' time, this figure we will compare with the forward and see what is happening. But here they are not asking that. They're just asking you how much you borrowed today and how much you're going to deposit today. The borrowing happened in euros, so I'll put the euro figure. The deposit happens in dollars. So that's why I get the dollar figure. Okay. Right. Take it down if you haven't. And then we can do the next one. Okay. Right. So let's move on. Complete the following statements. The 1 year expected future spot rate predicted using purchasing power parity theory is what? Okay. So it's a repetition. I think they had already given me the inflation rates over here. Okay, inflation is there, spot rate is there. To get the future spot rate, you can simply use the equation, right? So the future spot rate will be the current spot into 1 plus inflation in the counter currency over 1 plus inflation in the base. So spot rate was 2. 1 plus inflation in the counter currency was 3%. And home currency was how much? 4.5%. 1 plus 4.5%. So if you put that, you will get the future spot rate, which will be 1.971 to the dollar. So 1.971 euros will give you $1. We have that answer here. Okay, that was straightforward. It's a normal purchasing power parity theory. Okay. So that's it for the calculation. So usually again, section B, every question has 5, no? In that, mostly 3 will be calculations, 2 will be theory. Okay. Right. So now let's look at the theory. They're saying, which of the following statements about the use of a futures contract for zigzags hedging requirement is true? Now, if you are talking about zigzag, what is the situation here? They are going to receive euros, right? They're going to receive euros in 6 months' time, right? Now, when they receive it, they don't need the euros because they're based in UK, no? So what they will do is they will sell those euros and buy dollars, right? So they will sell the euros and they will buy dollars. That is what will usually happen, right? So if you, now this is the actual transaction, right? This is the actual transaction. Now, if you are entering into a futures deal, guys, you have to do the opposite. Okay. So if you are going to sell euros, then what you need to do for the futures transaction is you need to buy futures in 6 months' time. Because you will receive euros in 6 months and you're going to sell those euros, right? So for the futures deal in 6 months' time, the opposite should happen. If you're selling in 6 months, you have to buy the futures in 6 months' time. Now, if you need to buy futures in 6 months' time, today you need to sell futures first. Get it? Because the original transaction is what I have written in red. You're receiving the euros, you don't need it, so you're selling it in 6 months. Now the futures deal has to counteract this transaction, right? So if you're selling in 6 months, the future you have to buy in 6 months. If you're going to buy in 6 months' time, today what you have to do for the future, you have to do the opposite. You will have to sell futures today. Okay, so I would have actually told you something how to remember it, but the logic behind it is this. Okay, so in this case, it's a receipt. So you will go ahead and sell futures and buy it back at closeout. So you can see you're buying futures in 6 months, selling it today. Okay, so let's see which one is talking about that. A is saying you should buy euro futures and sell them at closeout. That's wrong. Closeout means in 6 months' time. We have to buy in 6 months. They're telling us to sell. That's wrong. Zigzag should sell euro futures now and buy them back at closeout. That seems to be correct. Okay, but anyway, I'll just read the rest as well. Zigzag should buy euro futures now and also on closeout. No, you can't buy and buy today and again buy again in 6 months, right? If you buy today, you have to sell in 6 months. If you sell today, you have to buy in 6 months. So these two are definitely wrong. So the correct answer there is B. Okay. Take it down, guys, because that's the explanation. You might get confused if you don't take this explanation down. I'll just make one small change here. Sell, I'll just say sell euros. Okay, so then what happens to the futures is here. This is the futures deal. Always remember the transaction and the future should be opposite.
Then expected to remember we get an asset, we sell futures to get the payment.
Yeah, you can remember. In your slides, I have given it like that. You have to sell futures today. Upsell. Because in 6 months, you have to do the opposite that you're doing to the transaction now. In the actual transaction, you're selling. That means in 6 months' time, for the futures deal, you have to do the opposite. You have to buy. So if you're going to buy in 6 months, today you have to sell. If you sell today only, you can buy in 6 months. Okay? Right. 30 is saying, which of the following statements about the use of a currency option for zigzags hedging requirement is true? Okay. So here again, what are we trying to do? We are trying to sell euros. Right? So if you are going to sell euros, when it comes to options, there are two types of options, right? There is a put option and a call option. I'm sure you can remember. Put means the option, the right to sell. Call is the right to buy, right? So let's see, if you want to sell, what you have to do? A is saying zigzag should use a call option. Call is the right to buy, right? We don't want to buy. We want the right to sell. So can't be A. Zigzag should use, again, B is also talking about a call option. So that is wrong. C is saying zigzag should use a put option. So that's correct. The right to sell on euros, as it gives the right to sell euros at a fixed rate at a point in the future. That seems to be correct. Because we have 500,000 euros, we want to sell it at a future date. If we can fix the rate today itself, that's good for us. Which option will give us the right to fix a rate to sell? A call option, not the put, because put option is the right to buy. Okay. So here, answer should be C. I'll read the D part as well. Zigzag should use a put option on euros and it gives the right to buy euros. That's wrong, right? It's not the right to buy. A put option is the right to sell. So the correct answer there will be C. The right to buy. This is the right to sell at a fixed rate. Okay, so sell euros means clearly it has to be a put option. Okay, take it down, the explanation, it will help. Okay, got it, right? Okay, so that is the end of section B. Okay, so now we have section C, 2 questions. One is based on NPV, the other one is based on cost of capital. Okay, so we will do both of them, okay, after the break. So let me quickly take attendance now. Today is the 9th, right? Rishad is not here. Amra is online? No. Fauz is not here. Inshika is here. Muftaz? No. Murshid is not there. Shehan is not there. Yumna is there, right? Amruti was there. Rajikshani? No. Umar Qasim is not there. Tarshana is there. Afsal is here. Hari Ashaf is also there. Hari Pratap is there. Shahad is not there. Kavindya. Dilisha is not there. Tarushi is here. The other two are not there. Let me check if I've got everybody. Yeah. Okay, so it's 11 o'clock now. Quickly take your 20 minutes and come back at 11:20. We'll do section C and finish off the paper.
Can you give me one that you
Okay, so let's start with this question. Goliath Company. I have a quick read through. It's to do with net present value. Okay, so we already did a question very similar to this not last week, the week before that, right? We did head back, if you remember. Very similar, just a few, differences. That's how NPV questions will be, right? 90% it will be the same. There'll be a few, changes from question to question. So again, the more questions you do, the more you will get exposed to these small changes that they can make. Okay? Right, so have a quick read through. And then we can try out A part. So A part is a calculation. B is just a theory-based question. C is also a calculation. Okay. Okay, so let me read through this question, okay? Right, so it's saying Goliath Company is a listed company which plans to meet increased demand for its products by buying new machinery costing 5 million, okay? So what is the, the problem that they have? They're trying to decide, okay, is it worth buying the new machine worth 5 million or is it not? Okay? The machinery would last for 4 years. Now, these things you have to note it, okay? So first thing you have to know is that the price, first thing you have to note down is that the price is 5 million and the life of that particular machine is 4 years, at the end of which it would be replaced. Now, this replacement is actually important, right? Usually in NPV questions, we use a machine, we scrap it, and that will be the end, right? We don't try to buy another machine to replace, no. But in this case, they're replacing. So something might change there, okay? Scrap value of the machine is 5% of the initial cost. So that is also there. Scrap value is also given. Tax allowable depreciation would be available on the cost of the machinery on a 25% reducing balance basis. So tax allowable depreciation is going to be 25%. With a balancing allowance or balancing charge claimed in the final year of operation. So that is normal. Tax allowable depreciation at the last end of the 4 years, we will have either balancing allowance or charge. The investment will increase production capacity by 9,000 units per year, and all of these units are expected to be sold as they are produced. So the thing is, if you buy this new machine, our production capacity is going to increase by 9,000. Okay, so that is the good thing about this investment. Relevant financial information in current price terms is as follows. Current price means we have not inflated at all. Okay. So we have the selling price, which is 650 per unit, but we forecast an inflation of 4% per year. The variable cost, we have it currently at $250 per unit, but again, we are forecasting inflation of 5.5%. Incremental fixed cost is 250,000. Inflation for that will be 5%. In addition to the initial cost of the new machinery, initial investment in working capital of 500,000 will be required. So there is a working capital situation as well. They're saying the initial investment will be 500,000. Investment in working capital will be subject to the general rate of inflation, which is expected to be 4.7% per year. So here they're talking about working capital and how that will increase. Then here they're speaking about tax allowable depreciation. Okay. Goliath pays tax on profits at a rate of 20% per year, 1 year in arrears. Okay. So this is a normal situation. The company has nominal after-tax cost of capital of 12% per year. They're asking you to calculate NPV. Okay. Now here, Selling price has a separate inflation, variable cost has a separate inflation, fixed cost has a separate inflation. So clearly you can't use the real method. You have to use the nominal method where you have to inflate everything and then do the calculation, right? So let's start off by inflating selling price, variable cost and the incremental fixed costs. Right. So this is how I would structure it. I'll call it sales revenue. Okay, I'll call it working number 1. Okay. So selling price currently, I know it is how much? Let me check. Currently selling price is $650 per unit. But now in year 1 onwards, it's going to get inflated by 4%. So I will get the inflated figure. So currently it's 650. So I'll just put here not, or don't, because it usually year not's figure, we don't put it now in the pro forma. So let's just keep it in mind that it's 650. And year 1, 2, 3, and 4, let's inflate it. So here it will be 650 into the inflation rate was 4%, right? So into 1.04. So that will be 676. So here it will be, you can actually take 676 and multiply that by 1.04. That will also give you the inflated figure. 703. And here 703 into 1.04, which is 731.1616. And here it will be this into 1.04. So every year I have inflated it. So I put it to 2 decimal places. Okay. So that is the selling price inflated. So I'll just put inflated selling price. Okay. So now if I multiply it by the number of units that I can sell, that will give me the sales revenue, right? So if you look at the question, how many units am I going to sell? They're saying the investment will increase production capacity by 9,000 units per year. So every year I can sell this additional 9,000 units. So that will be the sales units per year. Okay, 9,000. I think one of you, I'm not sure if it was Basit or whether it was Tarushi or Yumna. One of you, you had inflated the sales, right? They didn't tell you that that 9,000 is going to increase, right? They told you that every year you will sell 9,000 more, but they didn't talk about that figure increasing, right? So that was the error there. So you have sales revenue, which will be this into 9,000. Okay, so that will be, I'll do it in thousands. Okay, so I'll convert it to thousands in a bit. Right, so let me do this in thousands, sales revenue. It's easier if it's in thousand. So this will be 6084. This will be 6327. This will be 6580. And this will be 6844. You can put the whole figure, not a problem. I'm just doing it in thousands because it will make my statement look nicer. Okay, that's about it. Right, so that will be the sales revenue story. So now we need to inflate the variable cost as well. So I'll do that. Call that working number 2. Okay, so if I go back to the question, currently the variable cost is 250. It's going to inflate by 5.5%. Okay, so let me do it for every year. 1, 2, 3, 4. variable cost. Currently it is 250, right? Yeah, 250. So we need to inflate by 5.5%, so 1.055. So that will be 263.75 in year 1. Year 2 also it will inflate by the same amount. So in your exam, you will be able to, kind of drag the same equation across, right? I'm not able to do it because this is the iPad's version of Excel. Okay. Right. So let me take this to 2 decimal places. Okay. So that will be the variable costs. Now to this also, I will take the sales of 9,000 and do the multiplication. Okay. So variable cost will be this into this. Okay, so I've just done the multiplication. I'll do it, I'll type it in thousands as well. So it will be easy for me to copy into my proform. So this will be 2374, 2504, 2642, and 2780.
2.05
There?
2.05.
Yeah, okay, 250. Right. Okay, so I'll just highlight this. So it'll be easy for me to, take the figure that I need, right? So I need to take this to the statement and I need to take this also to the statement. Okay, so I have inflated both the sales revenue and the variable cost. Now there was an incremental fixed cost, right? So that also I will inflate. Okay, so here 1, 2, 3, 4. So if you look at that incremental fixed cost, it was 250,000, which is going to inflate at 5% every year, right? So year 1 onwards, I will inflate 250,000 and let me do that also in thousands. So it will be easy for me. Okay. So this will be 250 into 1.05. Okay, so that will be 262.5. Then this will be this into 1.05. Okay, this also you can take it to the nearest whole number even, no problem. Okay.
That didn't change.
Sorry?
That didn't change.
Oh, sorry, where is that? Because I have put into 1. Okay. So let me reduce the decimals. Okay, so this is only the incremental fixed cost. This has to go to the statement. So this also I will highlight. Okay. So now I have this, I'll call this working number 3. Okay, now I have done most of it, right? So if you look at the question, I have taken the selling price, I have taken the variable cost as well as the incremental fixed cost. Now after this, I have to do tax allowable depreciation and working capital adjustment. Now before I do tax allowable depreciation and working capital, I have to take certain totals. Okay, so in the NPV pro forma, there are certain totals that I have to take. So I will go ahead and start on the NPV also. Okay, so let me just leave some space here. Okay, I'll just leave some space here for tax allowable depreciation. Allowable depreciation. I'll call that working number 4. Okay, and another space for working capital. And I'll call that working number 5. Okay, I'll come back and do this. Meanwhile, let's do the net present value. Okay, let's do everything in thousands. Okay. Right, so I will have year naught, year 1, year 2, year 3, year 4. I might need year 5 because taxes are paid in arrears. Okay. So I will start with the sales revenue, which I have in working number 1. So I will copy that. Over here, that's the sales revenue. Okay, I need to push this a little to year 1. Okay, so that's the sales revenue. Then I will take the variable cost. This also be careful, okay? It has to come under year 1. And then I have the fixed cost. Okay, so at this point, I need to take a total. That's what I was trying to say. Okay, I'll remove the highlights because it's the statement. You don't need to have it highlighted. Okay. So here I take a total. I'll call that the cash flow before tax. Okay. So how do I take that? That will be the sales revenue minus variable cost minus sales revenue minus variable cost usually you should be able to do it, but it's fine. Okay, in this case, I'll just take the deductions. Okay, so what I will do is, since that's giving me trouble, I will put these as negative figures. Okay, so minus 2374, minus 2504, minus 2642, and minus 2787. Because if I do it like that, I can take the sum. Okay, so that way it will anyway automatically subtract 263. Okay, so all of that is there. So here what I will do is I'll take the sum of this entire cost. So that will be 3447. I'm not able to drag it. This is totals, okay? Okay, and let me take it to the nearest whole number. Right, so that will be the cash flow before taxes. So I can take, I'll just bold this. So now what I will do is I will calculate the tax figure. Okay, so I know the taxation rate was how much? Tax on profits is 20%. Okay, so I will calculate that directly, but it is paid 1 year in arrears, right? So 20% of 3447 has to actually come under year 2. So this will be this into 20%. So that will be 689. Here it will be 3547 into 20%. It will be this into 20%. Okay. So this also, let me round it to the nearest whole number. Okay, so those are the taxes. So now that I have tax, I can do the calculation for tax allowable depreciation, right? So let me go back. I had kept some space here. Let's try how to do tax allowable depreciation. So what did they tell me about it? They told me that tax allowable depreciation is 25% on a reducing balance basis. And I know that we are paying in 1 year in arrears. Okay, so it's just a normal tax allowable depreciation calculation. Okay. Right, so we have the years 0. We start with year 0. We had an initial investment, which was how much? For this particular machine, initial investment was 5 million. Okay, so let's do it in thousands. Okay, let's do it in thousands. So 5 million means we are talking about 5,000. Okay, so initial investment is 5,000. To this, in year 1, you will claim tax allowable depreciation at 25%. So 25% of 5,000, you will claim 1,250. Okay, so this 1,250, you will actually deduct it. Okay, so at the end of year 1, you will have a written down value of 5,000 minus 1,250, which is 3,750. Okay, then in year 2, what will happen? Again, you will have this tax allowable depreciation, 25%. But this time it will be 25% into 3,750, which is 937.5. So minus 937.5. So written down value 3,750 minus 937.5 will be 2,812.5. Okay. Year 3, same thing. Have the same tax allowable depreciation, which will be 25% of this figure, which is 703.125, right? So I'll take it as 703.1. Written down value 2812.5 minus 703.1 will be 2109. Okay. In year 4, you will scrap it off, right? So you have the disposal or the scrap. They told me how much was scrap value? 5% of the initial cost. So initial cost was 5,000 means scrap value will be 5% of that, which is 250. Okay. So this figure you will deduct. And then you will get either balancing allowance or charge. We'll see what it is. 2109.4 minus 250. It's a positive 1859.4. So this is actually a balancing allowance. Okay. Right. So let me just bold the tax allowable depreciation figures because that's what we need, and the balancing allowance. So now if you want to find out the tax savings, you have to basically take your tax rate, which is how much? 20% per year. Take the tax allowable depreciation figure, multiply it by the tax rate, which is 20%. So 20 into 1,250. Okay, I'll put the working as well. So this will be 1,250 into 20%. You don't have to show this in your exam. I'm showing it just for you to learn. Okay. 937.5 into 20%. Okay. 703.1 into 20%. And finally, 1859.4 into 20%. Okay. So the tax savings, you can calculate it easily, which will be 250 in year 1, then 188, then 141, and finally 372. But we are not done yet. Be careful with the timing, okay? Because we are paying tax 1 year in arrears, right? 1 year in arrears means this tax savings that comes under year 1, you will actually realize it 1 year later in year 2. This will happen in year 3, this will happen in year 4, and this will happen in year 5. Okay, so be careful. When you're putting it in the pro forma, you should put it under the correct years. Okay. So now we can go ahead and put these figures into our NPV table. So we'll call it tax allowable depreciation. Working number, what is that? Working number 4. Okay, so under year 2, we will have how much? 250. Under year 2, 250. Then year 3, 188. Then 141. And 372. Okay, so that will be the tax allowable depreciation figure. I'll put the tax as negative, so it will be easier for me. Okay. One minute. I'll just put the tax figures as negative, so minus 689. And this is minus 709. Minus 730. And minus 751. So it's easy for me to take a total, right? In your exam, you won't have a problem. Thing is here, I'm not able to add and deduct more than 2 cells. Okay, so that's why I'm putting it as negative. So I can just take the addition of the entire column just for ease. But in your exam, you will be able to, deduct one and add the other one. So that shouldn't be an issue. Okay. Right. So then we have the tax allowable depreciation. That's fine. Last thing we need to get is the working. Yes.
Do you have people on?
I'm sorry?
Do you have people on?
Yes, I do.
How many?
9.
Yeah, we went to Halloween.
Halloween, okay.
Yeah, we are here to promote.
What?
We are here to promote.
Come. Yeah, you can come.
4 people.
Guys, this is Tabish. What's your position?
President.
President of the Student Council. He wants to say something about Halloween.
Hi guys, we are having a Halloween event tomorrow. 4 p.m. onwards, we are having a DJ, we are having a costume contest and everything. So y'all can join us if you want. It's tomorrow, starting from 4 p.m. to 10 p.m. onwards, or might go on. So if there's anything, you can message me. My number is can you type that?
Yeah.
076 155 6436.
Okay.
Yeah, it's a business.
436, yeah.
Okay.
So yeah, if there's anything, message me. 6436. That's fine.
Okay.
Okay. See you guys. Thank you. Thank you, miss. Thank you very much.
Okay, so this is Tabish's number. You can contact him if you have any queries. Okay.
Thank you, miss.
Okay. Okay, so the last adjustment that I have is that of working capital. There is a small catch, okay, when it comes to working capital. So please pay attention, okay? So I hope this is fine. Just put it. Right. So if you look at the question and you look at working capital, they're telling you, in addition to the initial cost of the new machinery, initial investment in working capital has to be 500,000. And they're saying investment in working capital will be subject to the general rate of inflation, which is 4.7% per year. Okay. So let's just do the normal calculation. First, we will see what the total working capital will be and what's the incremental working capital. Okay. So if you look at this, they say, obviously, working capital has to be in place in year 0 itself. I'm sure you remember that. Year 1, year 2, year 3, year 4. Okay. So if you look at the working capital requirement, this also let me do it in thousands itself. Okay. In year 0, it was supposed to be 500,000. Okay. So year 0, I will keep it as 500. That's fine. Then after that, they're saying every year it has to increase by 4.7% now. So in year naught, it will be 500 into 1.047, which will be 523.5. So every year I will increase it by 1.047, 4.7%. Okay. So let me take this to 1 decimal place maybe, or 2 even. Okay. So this is the working capital requirement. Okay. So now we know that we only take the incremental working capital required, right? So this will be incremental working capital, right? So in year naught, we have not invested anything in working capital. So the entire 500 you will have to invest. Okay. Then in year 1, we need 523.5. But we have already invested 500, right? So only the extra 23.5 you will invest. Okay, so that is fine. Then if you look at year 2, we need 548.1. We have already invested 523.5. So what is remaining? The extra only we will invest. So that will be the subtraction of these two numbers. 24.6. That's what we will invest. Okay. Then in year 3, you can see 573.87. We have already invested 548. So only the remainder we will invest, which is 25.76. And now the catch is over here, right? Now, usually, if you are going to sell a machine and it's not going to be replaced, meaning you're going to sell it and that's about it, we will say the entire working capital, it can be released. In the last year, we say that, right? The entire working capital, it can be released. But in this question, they said, after this 4-year period, the machine is going to be replaced. And you see, they're saying it's going to be replaced. That means if you have already been investing in working capital, you can't suddenly take all that working capital out because there will be another machine that is coming in. For that machine, you have to put in the working capital required, right? So in this particular question, since the replacement is happening, the entire working capital, we don't consider it to be released back into the company, right? So in this case, we will continue with the normal incremental working capital itself, which will be 26.97. Okay, so I'll repeat myself again. Usually, when there is no replacement, okay, in the last year, this point, we will basically we will put 573.87 and say the entire amount has been released back into the system. Okay, but in this case, because there is a replacement, we can't do that because once the new machine comes, we have to still cater to the working capital of the new machine. So we need to continue this working capital until the day where you sell the new machine and don't replace that particular sale. Yeah, it's like this, right? Can you remember how to do normal working capital? It will until year 3, it will be the same. In year 4, what we will do the last year, we will say the entire working capital has been released. So 573.87 or 600.84, whatever it is, we will say everything is released. That's it, finished. But in this case, the machine is not just getting sold and we are not forgetting about it now. With that money, we are going to buy another machine to replace. So the moment you replace it with another machine, that machine has to run. So for that, you have to put in working capital. If not, it can't run. So we have to consider this working capital cycle to continue in this case. So that's why we are just taking 600.84, subtracting 573.87 and taking the 26.97. That's the difference between this question and all other working capital questions. That replacement fact. Got it? Online got it? After you can do everything under one row. I'm sorry, I just saw your message. Whatever is comfortable with you, you can, but make sure whatever you do is clear for the exam. Okay. Right. So let me just take this to the nearest whole number. It's working capital now. Okay. So incremental working capital. This also has to go to the statement. Okay, so let me put it here. just check. Okay, so this has to come correct, right? Year not itself, the 500 has to be there. Fine. The 524. Why is this 250? It's not 250, right? This has to be 25. Then this has to be 26. This will be 27. Okay, so all of them, I'll make it negative figures. It's there correctly over here, okay? Okay, so this will be minus 500, minus 24, minus 25, minus 26, and minus 20. Okay, so that's it for the incremental working capital, right? So I think I have taken everything that I need to. Tax allowable depreciation, working capital, everything is done. Okay, so now I can take a total and get the present value. So I'll call this the after tax cash. So this, I forgot one thing. I forgot the initial investment and the scrap, right? So I'll just take that as well. Initial investment, that will be 5,000. Okay, and the scrap. Which will be 250 at the end of year 4. Okay. Right, so now I can take totals. Minus 5,500 for year naught. Six, 6,870. 1 second. I made a mistake there, okay? Because 3,447 is already a total, so I can just start from there. So 3,447 minus 24 also will do the trick. That will be 3,423. So from here, take this up, okay? Okay, so minus 379. So I'll just check if the totals are there. Minus 5,500, 3,423, 3,083, 3,101, and 3,387. Okay, so all of that is there. Now let me discount it. Discount factor. They told me the rate was nominal after tax cost of capital is 12% per year. So the rate is 12%. Okay. Year naught is always 1. Go to the tables and take the figures for 12%. Tables will be there. So present value table 12%. 0.893, 0.797, 0.712, 0.636, and 0.567. Okay. So 0.893. Point 636. Okay, 0.636 has to come here. And 0.567. Okay. So now just take the present value at 12%. Minus 5,500. Multiplying these two figures, okay? Right, so let me take this to the whole number. right? So now if I want the net present value, that will just be the sum of all these numbers. Okay, so 4161. Okay, so always remember to say this, the project has a positive NPV, which indicates that it should be under. Okay, I think Basit, when you had done it, you had not given me that last line. This last line alone is 1 mark. Okay, right, so that's how you do the NPV. Okay, so you can cross check, those of you who did it, cross check to make sure that all the figures are there. Okay. So if you look at the question, what did they ask me now? They asked me to get the NPV, which I have already got. Then they're saying, comment on its financial acceptability. So that also I have done. Okay. Right. So I'll give you a minute if you want to, cross check anything, and then we'll do B part. Okay, done. So I think, I'm not sure if it was Yumna or Tarushi. One of you had got the tax timings wrong. Right, you had calculated everything correct, but the timings were wrong. Okay, so you had forgotten about that arrear story. Most all of you didn't get the working capital because that is something we haven't done so far. But otherwise, more or less, you had got more than half the mark. So that's a good sign. Okay. So do more and more NPV questions. You will see how they will give you different scenarios. So here what is new is the fact that the working capital was treated the way it is. Okay. Right. So that is that. Let's look at B part. It's a theory-based question. It's saying, discuss the difference between a nominal or money terms approach and a real terms approach when calculating NPV for 4 marks, right? So it's a very simple thing. Okay, the thing is, when you have cash flows, you can inflate it and then carry on with the calculation, or you can choose to do NPV without inflation. If it is the nominal method, you have to inflate all the cash flows and use the nominal after-tax cost of capital. In this case, it was 12%. If it was the real method, you won't do any inflation, but you will use the real rate. How will you get the real rate? You have the nominal rate, you have the inflation, use the Fisher equation, get the real rate, and then go ahead with the calculation. This case, you can't do it because there are specific inflation rates. If selling price, variable cost, fixed cost, everything was getting inflated at the same percentage, you can use real method. But here, since they are inflating at different percentages, you don't have a choice. You have to use the nominal method. You can just mention this and easy 4 marks. Okay. Right. Then it says, Goliath has been given the option to lease the asset instead of purchasing it. The lease payments would comprise of 4 annual payments of 1.35 million paid in advance, with the first payment being at the start of Goliath's accounting period. The present cost of purchasing the asset is $4,097,000. Post-tax cost of borrowing is 8%. Okay. So this is a classic lease versus buy decision. The buy's answer is already given to you. So you don't have to do any calculation to do with the buying, because they're telling me that the present cost of purchasing is 4.097, right? So the only calculation you need to do is to get the present value of this leasing option. So they're telling me 4 payments, 1.35 million is paid in advance, right? So usually I tell you it's best if you can, have a small timeline to show you what's happening. So you have your, okay. So you have year naught, year 1, year 2, year 3, year 4, and I'll take year 5 also. So what's happening in year naught? Okay, so if you look at year naught, you are going to have lease payment of 1.35 million. So one will happen here, one will happen in year 1, year 2, and year 3. So that is the 4 lease payments done. Okay. Then for these lease payments, there will be a tax savings. But if you remember, when it comes to leases, the savings happens 2 years later. Okay, so this is something we already discussed. So for this 1.35 million, for example, the tax savings will start in year 2. So that will be 1.35 million into 20%, which is, put it over here. Okay, the tax savings will be 270,000. So that will start here. So 270 here, 270 in year 3, then 1 in year 4, 270, and 1 in year 5. So these are the only cash flows that we have to consider when it is the lease payment. Okay. So why is it 2 years later? I already explained it at the beginning. It's like this, since it's year naught, right? By the time you claim any tax savings, it will be year 1. So anything that you're claiming for year 1, if taxes are paid in arrears, you will be able to get the benefit only in year 2. So that is why it ends up coming to year 2. Year naught's figure ends up coming to year 2. Okay. Right. So just a matter of getting the present values over here. So I'll put it in an Excel sheet. Okay. So this is the C part. Right. So I have the lease. I have years not 1, 2, 3, 4, 5. Okay. So in year naught, I will have the least cost. It is 1.35 million. So 101,350,000. That will happen for 4 years. So 1, 2, 3, 4. Then the other payment will be the tax. I mean, the other cash flow will be the tax savings. Year 2 onwards, you will have 270,000 for 4 years. Okay. So now what you have to do, take the net cash flow. Here it will be the same. Here also it will be the same. Here you have to do a deduction. 1,350 minus 270. Same here. And here it will be 270. Okay. So in the first 3 years, it's actually a cash outflow, right? Because the least cost is more than the savings. So overall, it's a negative cash flow. Whereas year 4 and 5, it's only the savings. So that will be positive, right? So I think it's better to put it as negative itself. This will be right? So that's the net cash flow. So now what you need to do is get the present value. So they told me to use how much? 8% post-tax cost of borrowing, right? So discount factor at 8%. Here not, it will be 1. Go to the tables, 8%, it will be 0.926, 0.857, 0.794, 0.735, and 0.685. Okay. So then we can get the present value. This into this. So you can drag it down since it's vertical, I can also do it. Okay. So then you can take a total over here. Which is 4,860,000. Okay. So this is the present value of leasing. Okay. Now what you need to do is you need to compare this with the present value of buying. So if you look at the present value of buying, it is 4,097,000. Present value of leasing is 4,860,000, right? 4,097,000 Here it is 4,860,000. Okay, so actually you can see present value of leasing is lesser than the present value of buying. It was negative 4,097,000. Okay, so cost wise, you can see that leasing is cheaper, right? So this particular company should go for the lease as opposed to the buying option. Okay, both will cause you cash outflow. Okay, both are expenses where the leasing is less expensive than buying. So we will go for the leasing option. So I will say that as the lease cost of 4,860,000 is cheaper than the buying option. Goliath company should choose to lease. Yes. Yeah. So that's it. That will give you the marks that you're looking for. Take it down because I don't think you guys have got this. Any questions, guys, online? Are you okay? Okay. Done? Any questions online, guys? You have to ask, man. If you don't ask, then you won't learn. Okay. Right. So that will be this particular question, right? So that's it for question number 31. 20 marks there. Okay. Right. So 32 is from cost of capital. It's a very, very common question from cost of capital. So please pay attention to the way we're doing it. Okay. So it says here, Oxfield Company, a listed industrial company, is considering a major investment. The company's investment projects team needs an appropriate rate at which to discount the estimated after-tax cash flows for the investment. So they're saying this company also, they may be doing something like what we did. They may be trying to calculate an NPV. Okay. Now for that, they need a after-tax cost of capital. Now here, they already gave it to me, 12%. So this 12% only we are trying to find for this Oxfield company. Okay. Following the company's normal practice, this is to be based on the weighted average cost of capital. So how are we going to do the calculation? Based on WACC. Figures relating to long-term financing are as follows. I have 160 million ordinary shares. Each share is worth $0.5. So total is 80 million. Share premium account is there. A revaluation reserve is there. Retained earnings are there. 8% preference shares of $1 each is there. 7.2% loan notes are also there. The loan note interest for the current year has just been paid. Interest is payable at the end of the next 3 years, and all of the loan notes are to be redeemed in cash at a 5% premium at the end of 3 years. So this is something to do with the loan note. Okay, so I'll just mention it here. Something to do with the loan note. The most recent dividend has just been paid. Dividends over the past 4 years have been as follows. So they have given me the oldest dividend and the most recent dividend. Chances are that I have to do the extrapolating of past dividends to get the growth. Okay. Current share price is 2.1. The loan notes have a market value of 97 and the preference shares are currently worth 0.85. So all the market values are here. Market value of the share, ordinary share, market value of the loan note, and the market value of the preference share. Corp tax is expected to be 21% for the foreseeable future. Fine. Calculate the company's WACC, explain your workings and any assumptions which you have made, justify the basis of the weightings which you have used. Okay. So to do WACC, you need two separate figures. One is you need the cost of capital itself and you need the market values. Okay, so if you're going to take cost of capital in this particular question, there are three different instruments, right? We have ordinary shares. Okay, we have the preference shares. And you have the loan. Three separate financial instruments. Now, you need to know the cost of capital of the ordinary shares, meaning you need to know KE. You need to know the cost of capital of the preference shares, which is KP, plus you need to know the cost of capital of the loan note, which is KD, if you remember. Okay. In addition to this, you need to know the market value of ordinary shares, market value of preference shares, market value of loan notes as well. If you have these two figures only, you will be able to calculate WACC. Okay. Right. Now, based on this information, let's do it one by one. Okay. So, if you need to know the cost of capital of ordinary shares, you need KE, right? If you remember in the cost of capital chapter, I told you there are two ways you can calculate KE. One is the dividend valuation model. Other one is what? CAPM. Okay. Now here I don't have anything to do with CAPM. I don't have betas. I don't have risk-free rates or anything. So definitely getting KE has to come from the dividend valuation model. Okay. Getting KP also dividend valuation model. Very simple. We'll do that. Getting loan notes. If you want to get KD, if you remember, you have to do an IRR styled calculation. This is something that was the basic thing that we did when it came to cost of capital. Okay. So now for each of these instruments, let's first get their cost of capitals. Then let's get their market values. And I'll show you how to do the weighting for WACC. Okay. Right. So let me go to a sheet again. I think this was Oxfield Company. Okay. So let's start with the cost of equity. I'm going to get KE. Right. So to get cost of equity, I'll write down the equation that I need to use. Okay. So I need to find KE. I will have to use the dividend valuation model. Okay. So what is the equation? P naught equals to D naught times 1 plus G over KE minus G. So in this case, I'm trying to make KE the subject of the formula. So I will do the rearranging as well. So KE should equal to D naught times 1 plus 1 plus G. One plus G over P naught plus G. Okay, so both equations are given to you in your exam, so you don't have to worry about it. Okay, right. So now if I want KE, I need the dividend of the current year and the growth rate as well, right? So first let's see if we can get the growth. Right. So I know that the most recent dividend is 28.8 and the oldest is 23.5, right? So I can do the extrapolating of past dividends and go ahead and get the growth rate, right? So let me do that first. So to get growth, I'm going to use extrapolating past dividends. Okay. So I know that the current year's dividend was 28.8. Okay. And what else do I know? Let me just check that 1 second. Okay, there's a small catch in this question. Okay, they're telling me total dividend is 23.5, 25.6, 26.9 and 28.8. Now tell me this. When I usually do extrapolating past dividends, do I take the total dividend figure or the dividend per share figure? I take the dividend share, right? I don't take 28.8 million as a whole figure, right? So here, since I'm taking that 28.8 as a whole figure, I don't have a choice when I'm using the dividend valuation model. Can you see that there is a P naught over here? That is a market price per share now. Instead of using the market price per share, I won't have a choice. I have to use the total market value of the company. Reason for that is usually D naught is a dividend per share. So this is P naught, market price per share. But in this case, since I'm given the total dividend, I have to be careful when I'm taking P naught. I can't just take the market price per share. I should take the market price per share into the number of shares issued. Okay. Right. So let's go ahead and get the growth rate. I'll take the entire 28.8 divided by the oldest dividend that I have is 23.5. Over to the power 1 over n. N is the number of years behind, right? So that is 1, 2, 3 years ago only it was 23.5. 1 over 3 minus 1. So the growth rate will be 0.07, which is 7%. Okay. So now I can just put in the figures over here. So D naught current dividend was 28.8 times 1 plus 7% over, usually I can put just P naught, which is how much? They're telling me current share price is 2.1, right? So usually I can put 2.1, but in this case, I will multiply it by the number of shares in issue as well. I will multiply it by 160 because I'm using the total dividend, not just the dividend per share. Okay. So that will be 2.1 into 160 plus the growth rate, which is 7%. So that should give me KE. Okay, so KE, put this in your cal, you should get it as 16.17%. Okay. Take it down. And mention here why this 160 was multiplied as well. Okay. So number of shares. Reason is because this is the total dividend. Okay, so KE, I've just highlighted it there, is 16.17. Cost of equity. Can we divide the total dividends? Yes. You can divide the total by the number of shares and then take DPS and then use the market price as it is. That's fine. Okay. So that will be the cost of equity. So now let's do the cost of preference shares. KP, we call it. That's very simple. KP, it has an equation equals to D naught over P naught. Okay. So let's look at the question. D naught, you can see it's 8% preference shares, $1 each. That means 8% into $1 is going to be the dividend for that particular preference share. Okay. So that will be $0.08. We can take it as cents because then it will be a round 8 figure. Okay. So the dividend will be 8% into 100 cents, which is 8. And if you look at the market value, they're saying preference shares are worth $0.85 per share ex dip. So everything is given to me here. So D naught, I'll show you how I got it. 8% into, I'll just take it in dollars itself, $1. So that will be 0.08. 0.08. Okay, so that's D naught. P naught, they're telling me it is 0.85. Okay, so all I have to do is take 0.08, divide it by 0.85. Okay, and multiply it by 100. That will give me KP. So KP is going to be 9.41. Okay. So I'll just highlight it. That's KP, simple. So KE I have, KP I have. Now I just need the cost of debt. Okay, so cost of debt, KD. So for KD, we need to do an IRR style calculation. So how do we start, right? Right, so they're telling me the loan note interest for the current year is paid. Interest is payable at the end of each of the next 3 years. So for the next 3 years, I have to pay interest. And all the loan notes are going to be redeemed in cash at 5% premium at the end of 3 years. So in year naught, the market value, currently the market value for these loan notes, they are giving it to me at the bottom, right? They're saying it is $97 today. Okay, the market value of the loan note is 97. Then year 1, year 2, year 3, I will have to pay interest. And at the end of that 3rd year, I will go for a premium, meaning every loan note is worth $100. When I'm doing the redemption, I will have to redeem at a 5% premium. Okay, so that's what they're telling me about this particular loan note. Right, so now let me put it into the IRR style calculation. So I'll have the years 0, year 1 to year 3, and then at the end of year 3, you have the redemption. So here I'll put market value. Here I'll put the interest. And here we have the redemption at a premium. Okay. Market value, I know it was 97. How much is interest? I'll calculate in a bit. Redemption, they said it's a 5% premium. So all loan notes are $100. So when I'm doing the redemption, I have to do it at 105. Okay. Now for interest, they're telling me it's a 7.2% loan note. No. So 7.2% into $100, that will only be the interest that I have to pay. Okay. But That is before tax. I have to consider after tax interest. So that is important, right? So let me get the interest figure. Okay, so that will be 7.2% into 100. So that will be basically 7.2 multiplied by 1 minus the tax rate. Tax rate was 21%. So take that as well. I'll take it like this. I haven't multiplied it. Okay. That will be 5.688. Okay, so I'll take it to 2 decimals. 5.69. So that will be the interest figure that I have to put here. Okay, so now I have to do IRR now. So for that, what do I have to do? I have to take 2 separate discount rates, get the present values and use the IRR equation. Okay, so let me take maybe 5% and 10%. So discount factor at 5%, present value at 5%, then discount factor at 10% and present value at 10%. Okay, so here not, it will be 1. Here also it will be 1. Then year 1 to year 3 is an annuity. So go to the annuity tables at 5% and get the figure. It will be 2.723. Okay, and year 3, at the end of year 3, that is going to be not an annuity, just the present value table. 5% at year 3 will be 0.86. Okay, so same thing, I'll get the numbers first. If I go to the annuity table for 3 years and I look at 10%, I get 2.487. And go to the present value table for 3 years, it will be 0.751. Okay, then you can multiply these two. And here multiply the cash flow, careful, with the discount rate. Okay, so now I can get the total NPV here. Okay, so I have a positive NPV and a negative NPV. I can use the IRR equation now. Okay, so what's the IRR equation? Okay, so IRR equals to the lower rate plus NPV at the lower rate over NPV at the lower rate minus NPV at the high rate times the high minus the low. Right, so we had 2 rates, 5% and 10%. Lower rate is 5% plus NPV at 5 was 9.21. Over 9.21 minus NPV at the higher rate is minus 3.99. So minus 3.99 into higher rate, which is 10 minus the lower rate, which is 5. Put it in your cal. You should get the IRR, which is 8.49%. So that is basically the cost of debt. So KD. KD actually 1 minus T because it's after tax. 8.49. Okay. So now we have KD, we have KP, we have KE, everything that we need. So now just a matter of getting the market values and then calculating the WACC figure. Okay. So take this down and then I will show you how to get the market values. Okay, so now let's get the market values, okay? So for equity, preference shares and the loan notes, I need market values. The market value. So market value of ordinary shares, market value of preference shares, and market value of the loan note. All of them I need. Okay. So if you look at ordinary shares, I know that currently the share price is 2.1 and there are 160 million shares. Okay. So if I want to get the market value, it will be 2.1 into 160 million. Okay. So that will be 336 million. Okay. Then market value of the preference share, I know that every share has a market value of 0.85. And how many shares do I have? You can see that it was $1 each, right? So 12 million means you have 12 million shares in issue. So 0.85 into 12 million. So that will give me 10.2 million. Okay. Then the market value of the loan note, you can see here, they told me that the loan note is worth 97. Market value is 97. So if I know the number of loan notes that I have issued, I can multiply that by 97. I know that 67 million is the value of all my loan notes. Each loan note has a value of $100, right? So 67 divided by 100 will give me the number of loan notes in issue. That when I multiply it by 97, I should get the market value of these loan notes. Okay. So I know I have 67 million loan notes in issue, but that's a dollar figure. So if I want to know the number of loan notes, I will divide that by 100 first. And then I will multiply it by the market value of $97 per loan note. Okay. So that will give me how much market value of the loan note will be 64.99 million. Okay. So there you go. I have the market values. I have the cost of capital. It's easy to get the weighted average cost of capital. Okay. So how will I do that, right? So it's like this. You will have your equity, your preference shares. Okay. And your loan notes. Okay. Then put the market values first. So market value, when it was equity, it's 336. This is 10.2. And this is 64.99. Okay. So those are the market values. Then take the cost of capital. So if you look at equity, KE, we already calculated it. It was 16.17%. Put it here. Cost of preference shares, we calculated 9.41. And the cost of the loan note we calculated was 8.49. Okay, so now when you want to take WACC, this is what you have to do. You have to take the market value and multiply it with the cost of capital. So 336 into 16.17, that is 5433. You have to do it for all three. Okay. So now the next step is you need to take a total. Okay, so take a total for market value, which is 411.19 and a total here as well. Okay. So finally, when you want WACC, all you have to do is take this total 6080 and divide it by 411.19. So that will give you the WACC, which is 14.78. You can take it to 1 decimal place. So WACC is 14.8%. Got it? This is how you do the WACC. I know there is an equation as well, but might as well avoid it because if you're using the equation and there are a lot of instruments, you might go a little wrong here and there, right? So it's best to use the table, especially since we're having spreadsheets, it's faster to use the table itself. Got it? Any questions, guys? Guys, next week, please learn and come, okay? Revision classes, there's no point coming for a revision class if you don't learn. You'll be lost the whole class, okay? So only if you know what is happening, you will benefit, you will ask the correct questions. You can, if you have any issues with the question, you will be able to clarify that and all of that. If you're trying to come to the revision class and learn, it's not going to help. Okay, so please make sure next week you guys are properly, thorough with the syllabus. If not, it's not going to help. I'm telling you that again and again. Because if it's a revision class, so we will assume that you know the syllabus. We are trying to focus on the questions at this point. Okay? Right. So because there's no point doing more and more questions if you don't know the theory. You have to know the theory. Only then you can do the questions. So that's why at the beginning, I don't try to focus on the question because if I do that, you will get completely lost for this paper, right? So that's why we make it simple, give you the theory, but now is the time for you to actually apply, okay? Right, so that's how WACC is calculated. And I think that question has a little bit of theory as well. So let me go through that. So what did they say? Calculate the WACC that we have done. And they're saying explain your workings and any assumptions that you have made, right? So when you're doing WACC, there are a lot of assumptions that we make. So let me just show you the marking scheme. Where was that? Okay, just give me a minute. I will ask them to upload the answers onto the study hub, okay? Sorry, the LMS. Okay, so let's just quickly go through the answer here because it's all theory. Right, so assumptions, you can see when you're doing WACC, the formula for KE assumes that the future growth in dividend will be constant. We got the growth, we thought it will be 7% and it will always be 7%, not the case, okay? Then tax is assumed to be constant at 21%, okay? We assume that the market price that they're giving me 2.1 is actually a fair representation, may not be the case, okay? So if you can make 3 of these points, that will give you the maximum of 1.5 for the assumptions. And then basis of the weightings, can have a look at it. Both cost of capital and WACC have been calculated using the ex-interest market values rather than the statement of financial position values or the nominal values, right? So we're using market values and not the book values, first thing. The other thing is this is to ensure that the current market cost of finance is determined rather than a historic cost. So you know, I hope you know that WACC, you can weight it in 2 ways, either using book values or market values. In the slides itself, I tell you the best approach is to go for the market value. So that's what they're trying to say here. We have used the market value. The reason for that is only then you will use the current market cost rather than the historic cost. So the WACC will be more relevant. Okay, so if you can mention that, that will be 1 more mark. So out of the 11, you get 2.5 marks just for the assumptions and the basis of the weightings. Okay. So that is one thing. Then the next part of the question is, explain how the CAPM model could be used as an alternative means of determining a suitable discount rate for the assessment of the investment, assuming this is a new direction for the business. So I explained this 2 weeks ago. I told you if you're going to invest in a new business area, doesn't make sense to use the WACC when you're doing the NPV calculation, right? A better option will be to use this capital asset pricing model. So if you remember, that is where it says here, KE, you can go for a project specific cost of equity if the project activities are different from that of the company. So what do you have to do? You have to find a proxy company, meaning a listed company who is in that line of business, take their beta equity, de-gear it, re-gear it, then use the CAPM equation to find a project specific cost of equity. If you can just mention all of those steps, it's a solid 4 marks for you. Okay, so you can say, see here, find a listed company with activities similar to those of the project. look at the beta factor, adjust for gearing, put it into the CAPM equation. RF could be calculated using the yield on government yields. RM is calculated using the movements on the FT All-Share Index. You don't have to mention that. You can see that note isn't part of the 1 mark. Okay, so as long as you can say, put it in the CAPM equation and get KE, that is more than it. Okay, so that will be your 4 marks there. Final part, briefly explain Modigliani and Miller's theories on how gearing level impacts the value of a business, right? So Modigliani and Miller, they said that there were 2 different theories on how gearing level can affect the WACC. As the value of a business can be determined by its future cash flows discounted using the WACC, the lower the WACC, the higher the business's value. Okay. So then they are explaining there are 2 theories. One is without tax and with tax. So without tax in 1958, they have said even if you use cheaper debt, that is going to be offset by the fact that cost of equity will increase because equity holders will see it as risky. So that way there is no impact of the debt equity structure when it comes to WACC. But after that, 5 years later, they adjusted the theory. What did they say? Cost of debt is cheaper and you also get a tax benefit. So because of that, what happens? If you increase debt, you end up having you end up having a cheaper cost of capital because cost of debt being cheaper is more than the fact that cost of equity will increase. Okay. So that way, what they're trying to say in the second theory is to gear up the company as much as possible. So you have to have at least 99.9% debt because the more debt you have, the cheaper the WACC is going to be. The cheaper WACC is going to be, the higher the market value of the company. Okay, so just go through what they have mentioned here. I will ask them to share this marking scheme on the LMS so you can have a look at it as well, right? So in case you haven't tried out the paper also, you can try it out and see how the marking scheme goes, right? Okay, guys, that's it for this paper. So next week I will come with another paper which we can go through. And that paper will be a little bit more complicated than this one. So please make sure that you have learned properly. Okay, if not, you will be lost. You won't know what to do, right? So please make sure that you learn properly and come for that paper. By learning, I mean do more and more questions. Okay, right. Okay, then that's it for the day. I'll see you next Saturday, same time, right? That's why you have to do questions, and if not, you will keep on forgetting. Okay? Because that's when you do questions, and you actively learn. Keep trying.
Thank you.